level, but clearly it needed a little bit more of a takedown from there.
Didn't generate a ton of new excitement. I mean, obviously, it's a 25-year-old business. It's a pretty mature industry. It's not as if they're kind of creating, the whole playing field that they are operating in. So, not the fastest grower. I mean, obviously, it's an interesting business, one that's going to have a place for a long time, but it doesn't have the profile of one of those moonshots, I guess.
Yeah.
All right, coming up. Home building hit a near 2.5-year low in August, while building permits sank to May 2020 levels. But not even disappointing data can keep the home builders down today. Will a rate cut change the real estate narrative? That is next. Real estate narrative. That is next.
Welcome back to the exchange. Mortgage rates holding near 3-year lows ahead of the Fed decision. Diana Olick joins us now to dig into those numbers. Diana.
Well, Leslie, mortgage rates dropped yesterday to their lowest level in 3 years at 6.13%. And today, pre-Fed announcement, they're just slightly higher at 6.15%, according to Mortgage News Daily. Now, if the Fed does do the expected quarter-point cut, some experts predict longer-term bonds might sell off, increasing interest rates. It depends more on the commentary from the Fed meeting, but that's what happened last year after that first cut. Now, an initial drop in rates last week caused a massive run on refis, with those applications jumping 58% compared with the previous week. Refinance demand was 70% higher than the same week 1 year ago. All that, according to the Mortgage Bankers Association. Now, the refinance share of mortgage activity increased to nearly 60% of total applications. And the average loan size on refis reached its highest level in the 35-year history of the survey, as those borrowers would see bigger savings. Now, refis for ARMs, that's adjustable rate loans, were very strong, increasing to nearly 13% of all applications. And that is the highest level since 2008. ARMs, of course, can offer rates up to 75 basis points lower than the 30-year fix. Back to you.
Diana, thank you. Our next guest says lower rates will help widen the pool of prospective buyers, but most importantly, improve the market's biggest headwind, consumer confidence. For more, we're joined by John Lovallo, U.S. home builders analyst at UBS. John, good to see you.
Thanks for having me.
I mean, a lot of moving parts in terms of what drives housing demand and supply, I guess. Quarter point, you think that's enough to excite consumers, or is that part of the process of rebuilding it?
I actually think the most important thing is rate stabilization. So we're at 6.15, as Diana said. That's most important. Now, to the extent that we get a cut today and the long end of the curve follows, that's very good news. Lower rates are good for housing. It opens up the pool of potential buyers. It allows the builders to cut back on the incentives that have been hurting mortgages. And hopefully, it can unfreeze this existing home market that's been at GFC trough levels for 3 years.
I mean, the data
unfreeze this existing home market
as far as I can tell, right? On permits, on starts, you have more completion. So it feels as if there's this locked up situation in the markets. Why are the new home builders, you think, decently positioned to actually have some improvement from here into next year?
Counterintuitively, the lower starts number is actually a good thing because there's a little concern of inventory in certain markets. So the fact that the builders are showing discipline is very well taken by the market. Now, look, our view is 2026 is going to be a better year for housing than 2025. Volume is going to be better. We have a very consensus view that gross margins can actually be higher next year, even in a stable environment. So flat to slightly higher. That's very out of consensus. And there's green shoots that are happening out in the market that I'm happy to talk about. I mean, Toll Brothers talked about foot traffic improving. A top 5 builder said that the South has been very strong, and there's been a resurgence in Florida where there's been the inventory concerns. A top 15 builders told us that over the past 5 weeks, demand has actually been up mid-single digits year over year. So things are moving in the right direction. It's not an all-clear sign, but it's not getting worse.
Now, you mentioned that stabilization is critical in terms of kind of mortgage predictability and so forth. The Fed funds rate has essentially been paused up until what's likely to be, the next 10 minutes. But the market rate volatility has been present. Do you expect that market rate volatility to stabilize in a way that gets more people to take out mortgages, refinance mortgages, and so forth?
Very hard to say because there are other factors, including inflation, that play into that. Interestingly, there's been news about a third mandate for the Fed, right? Price stability, full employment, and potentially moderated long-term rates. Look, I don't know what the outcome would be longer term for the economy, but that would be good for housing in our view. Lower rates, again, stimulate demand.
Yeah, that's a third leg to the mandate that people have more or less said, well, it's kind of redundant, or it's just going to take care of itself. But who knows what that means down the road for balance sheet usage and stuff by the Fed. I guess the other question is affordability, which is obviously, pretty stretched at this point. Is there any hope there?
If rates come down, that certainly helps.
Yeah.
And what's been really interesting is the builders have been very effective in buying down mortgage rates. So if you went to a public builder, you weren't paying the 6% today. You're paying 5. You're paying maybe just under 5. To the extent that we can get lower rates, the key here will be the builders will not need to buy down, and that's very accretive to margin, or they won't have to buy down as much. And that's where the real kind of juice is, in our opinion.
So you don't see home prices falling then? When we get that unlock, when people do start to move, when it becomes more affordable from a mortgage standpoint, you don't think that's going to bring down home prices necessarily?
It's a very interesting question. I think the turnover is very important. Think about it. We're running at 4 million units of existing home sales, GFC trough levels. When an existing home is sold, generally there's a home that's purchased. That could be a new home. So just freeing up that kind of inventory is very, very important.
And just quickly before we go, what are your favorite names here in terms of the stock?
Sure. Top pick is Meritage Homes, which is an entry-level first-time buyer. We also like D.R. Horton on the low end. And then we kind of take a barbell approach, Toll at the high end, and Pulte Group as well.
All right. John Lovallo, appreciate it. Thanks very much.
Thanks for having me.
We'll see how the entire Treasury curve and mortgage rates do in the last little while. Of course, we are expecting that quarter-point rate cut. We'll see if the consensus is surprised today. It's going to do it for us here on the exchange. Power Lunch is going to pick up coverage of the Fed decision right after this quick break.
All right, the moment the market, maybe you have all been waiting for, has finally arrived. It is Federal Reserve decision day. Markets, they could be coiled to respond. Welcome to Power Lunch, everybody. I am Brian. Kelly is off, and you are just under 5 minutes away from the Fed's latest decision on interest rates. Wall Street anticipating the Fed will make its first cut of the year, 0.25% expected, but there is way more drama than just an interest rate cut that pretty much everybody and their mother's mother expects. We're going to get you the full storyline in moments. And with those moments to go, here's how things look. Stocks actually mostly on the rise. The Dow is up 0.5%. People don't really care about the Dow. Small caps actually up about 0.6%. They're seen as more of a beneficiary of future rate cuts. So maybe small caps are telling us something. The NASDAQ down about 0.4%. The bond market, the longer in, as they say, the yield not moving. Why would it? They want to hear what Jay Powell has to say. Maybe if there's any dissents. What do the dissents see? And then, of course, gold, Bitcoin, the U.S. dollar, the currency complex. Gold down just a bit, but gold at a record high as well. Bitcoin on the move, too. Bitcoin down about $1,000, but for Bitcoin, that's actually a relatively small move. All right, enough talk. Let's get right now to our all-star panel here, all in studio. We've got David Kelly, J.P. Morgan Asset Management, Francis Donald, RBC Capital Markets, and Jim Caron of Morgan Stanley Investment Management. All right, Bank of Canada is down. So here, Federal Reserve U.S., Francis, what happens today?
Well, we get a cut from the Federal Reserve, and they're probably going to emphasize that labor market is looking worse. But I want to hear how they characterize inflation, which is still too strong, likely to reaccelerate, and we're 53 months still above target. So this is a central bank that's...
Doesn't sound like a cutting environment to me.
Doesn't sound like one. So I want to hear how Chair Powell is going to navigate what is still an inflation problem and likely to become more of an inflation problem while he's still cutting.
Okay, David Kelly, do we get a cut today?
Yeah, we do. We get 25 basis points, but we shouldn't cut today because the
shouldn't cut.
The reason we shouldn't cut is because the Fed is further away from its inflation objective than its unemployment objective, and it believes it's going to be that way at the end of the year. I don't think we're on the brink of a recession here. It's a slow economy, but the problem is there's politics here, and there's also messaging. And I think what we're going to be looking at is how many people dissent. Do we get three? I mean, is it a prerequisite in order to be in the game for Fed chair that you have to dissent 50 basis points a day? Is that just table stakes? So that's one question. And then a second question is, does Jay Powell have to defend cutting rates today by saying the economy is looking really, really weak? Because that messaging actually hurts the economy. One of the things, whatever we get today, it's a rate cut does not help the economy grow faster at this point.
Jim?
So I think they cut 25 basis points, but I don't think it's just about the economy. I also think it's about the balance sheet, and I also think it's about liquidity. So what we've started to see is that repo rates have started to rise, bank reserves are falling. As the Fed has kept interest rate policy unchanged and the balance sheet has started to shrink, that has created some liquidity tensions in the markets. So part of the reason why I think the Fed should cut rates this time around is to address those liquidity issues and repo rates rising and bank reserves and all the like. So I agree, with David and Francis. Look, we can debate the economics around this. We can talk about the unemployment rate, but the reality is I think that the Fed's insurance is really based on liquidity.
Francis, we've got 1 minute to go, and we have possible dissents. How much does the non-interest rate stuff matter?
Well, for the economy, it's not what the non-interest rate stuff is. It's what the interest rates actually do. And I'm going to pick up on David's point here. We got to be really careful. We're going to get headlines all today. The Fed's cut rates. This is not going to improve the U.S. economy very much at all. What ails the U.S. economy is not interest rate sensitive. It's a massive trade shock. It is a labor shortage. It's an uncertainty shock at play. So even though we see a Fed today, even though we're going to see lots around dissents, and that matters to the story of the Federal Reserve, today matters way less for the real economy than maybe the headlines will imply.
Yeah, I've said it before, David. I don't know what the Federal Reserve does about, auto insurance rates that are up 40% in a year, electricity bills that are up 20% in a year.
Or what I call it, the tariff flu. The tariff flu both slows you down and also gives you a temperature. And that's really what's the problem here. And the Fed really isn't the remedy.
All right, so with about 10 seconds to go, we got the Dow up 0.6%. Small caps, the mid-cap stocks up about 0.2%. But I'm going to stop talking because Steve's got the decision.
Federal Reserve cutting interest rates by a quarter point as expected to a new range of 4 to 4.25%. New Fed governor and former CEO, current CEA chair, Stephen Myron dissenting in favor of 50 basis point cut. The median Fed official looking for 2 more rate cuts this year, but just barely. I'll get you details on that in a second. The statement importantly says the balance of risks have shifted. Downside risk to employment has risen. Job gains have slowed. Unemployment has edged up. And economic activity has moderated. At the same time, the statement does note that inflation has moved up and remains somewhat elevated, but clearly the Fed favoring the concern about employment here over the concern about inflation. It says uncertainty remains elevated as well. On the rate outlook and the so-called dot plot, some really interesting movements here. As I said, the median Fed official forecasting 2 more rate cuts this year, but just barely. There was massive disagreements among officials on the rate outlook for 2025. Very unusual with just 2 more meetings remaining. Let me give you the data here. One official doesn't want to cut at all. There was no other dissent in favor of not cutting today, but one wrote down the current rate or the previous rate as their dot. 6 want no more cuts after this one. 9 want 2 more cuts. And one official, I guess we can guess who it is, wants 5 more quarter point cuts this year, or 125 basis points, to bring in the Fed funds rate down below the median neutral rate. So there's a big time dove on the committee. I think the committee at the headquarters here will have some fun figuring out who exactly that is. The median wants 1 cut in 27 and 1 in 28. So I'll give you the numbers now. 3.6 is the median forecast for this year on the funds rate, down from the current of 4.125. So that's 2 cuts. 3.4 for 27 and 3.1 for 2028. A little bit more on the economic outlook. Core inflation unchanged. The outlook for this year at 3%. Unemployment unchanged at 4.5%. GDP pushed up a little bit to 1.6 from 1.4. 5 members want to go below the 3% neutral rate in 2026. That's up from 2 in September. So they're looking for a little bit of stimulus down the road next year in the funds rate. 6 want to do so by 2027. Brian, I'll send it back to you and the smart people around the table there to make sense of all this.
Well, that's a pretty smart person down there in D.C. too, Steve. Should we assume that it is new Fed member Stephen Myron that is calling for the 5 quarter point cuts over the next couple of meetings?
This was my speculation leading into this, and that's what I think it is, Brian. I think it's Stephen Myron out there basically doing the president's bidding, calling for very sharp rate cuts immediately. I guess that would be, in order to get there, you'd have to have a 75 and a 50 from here. So one of the remaining meetings would have to be a 75, one would have to be a 50 in order for Stephen Myron's outlook, or the person whose dot this is, their outlook to be accurate.
Yeah, that dot, as they say, is kind of like this Canadian reference, the yellow knife in the Northwest Territories, kind of way, way up and out there. Steve, stick around.
There was a joke, Brian, there was a joke among one of the Fed reporters here that we were going to have to get a legal pad to get the dot plot together. It'd have to be a longer piece of paper.
I love that. You go from the 11.5 inch to the full 14. I mean, I'm old enough to get that reference. Steve Leisman, thank you very much. Let's go back now to our esteemed panel. Steve is still there. We still got to look through it. By the way, I'm trying to recycle the internet so I can compare the two. Francis, your immediate take on this decision?
Well, hearing about that dot plot, maybe it'll come in defense of the dot plot. There'll be a lot of comments about this being very political in nature, but this wide dispersion in views on this Fed.
The Fed wasn't political.
Well,
it's independent.
It's independent. Let me just say, because there's going to be questions about this, that there is a lot of confusion about the state of the U.S. economy now. It's not clear how much should the labor market truly be weakening. When will tariffs come through? And some of this dispersion we might be seeing in dot plots, some of it, not all of it, may very well be a reflection of the confusion of this economic moment. So we have to be careful about taking any headlines about the median dot here from what I'm hearing, because we have huge dispersion within Fed members. This is going to call more attention into absolutely who is going to be at the Fed and who is going to be leading the Fed not too many months from now.
I think this is actually really important that there was only one dissent. Because what that tells me is that even though Governor Bowman, Governor Waller may want the job of Fed chair, they're not willing to go against the consensus of the Federal Reserve in order to get that. I think that is a very, very positive statement. So, I think, Jay Powell is Mr. Consensus. He wants to get consensus. Clearly, he talked to everybody before this meeting. And to me, the fact that they're not going to fall over themselves to say 50 basis points now, even if they want more Fed easing, I think that's a very positive sign because it says the Federal Reserve as an institution regards its independence as tremendously important, and they're not going to fall over themselves to do what the administration wants right now. And I think that's a very positive sign.
But our job, Jim, here is to look ahead. And if we are to assume that Stephen Byron or somebody else may become the next Jerome Powell, and that person is incredibly dovish, they want to lower rates, that maybe they are not entirely apolitical, what does that mean for bond markets? What does it mean for stock markets?
So ultimately, what we have to think about is the framework that the Fed is working through, which is the Phillips curve. So effectively,
what is that?
So the Phillips curve is a relationship between unemployment and wage inflation. So if the unemployment rate is going up, wage inflation and therefore consumer inflation is likely to stay relatively low. If the concern is that the labor market's going to weaken, then they are very likely to be able to say, I'll look past 3% inflation today because it's not going to be a problem because the unemployment rate will be very high. So therefore, we might as well cut. That plus the balance sheet, which I mentioned before. What it means for markets, though, is that you're seeing now wage inflation stay relatively low and likely to stay low, which means that profit margins are likely to be higher. You're already seeing productivity start to rise. So essentially, as I tease through these statements and these numbers and everything else, what this is telling me is that productivity is likely to start to move higher into 2026. It's already doing so in 2025. That means markets can support a higher multiple, and it's bullish for the equity markets in that sense, because higher productivity means growth with relatively lower.
Okay, speaking of the equity markets, a couple things I want to quickly hit and then get reaction to it. The macro, the bigger markets, not moving a whole lot. S&P 500 up 0.1%. Who cares? What is moving is the small caps, the SML Small Cap 600 Index. We don't talk about it a lot. It's up 2%. Here's why I'm talking about it, Francis, because small cap stocks, domestic American companies, almost entirely all their revenue is in the United States. Those stocks tend to move at the later end of a rate cut cycle. So I want you to comment on that move as well. And here's the other news. The 10-year yield didn't move at all. It's at exactly 4%. It moved down 1/100th of 1%. In other words, if you're out there looking for mortgage relief, you're thinking, let's wait and buy a home because mortgage rates are going to come down. The bond market is saying you might be out of luck.
Well, you have two issues in play here. One is that this market already priced in pretty significant easing from this Federal Reserve. So today was just meeting the expectations already in the market. You're going to have to out-ease those 5 cuts that were already put in if you want to see additional support coming through. But the second is, we've talked about it on this show before, we've got fiscal dominance in play and that long end of the curve where mortgages are more tied, in fact, fully tied, far less sensitive to what the Federal Reserve is doing and much more to what government is doing and what Washington is doing. So we maybe want to pay attention more to shutdown risks, budgets coming through if we want to focus about mortgage rates than we do necessarily the Federal Reserve.
Gary Cohn on CNBC earlier today said something very, very smart. Says a lot of smart things, David, but one of the things he said today was that we've got to remember the Federal Reserve, this rate call that we're talking about right now, the reason that we dragged you all to New Jersey, this is the overnight lending rate. It's like basically tomorrow. What our audience mostly, what JP Morgan's client base mostly cares about is what happens down the road, and the longer term bond market isn't moving.
No, but this is actually good news, because our great fear, I think all of us, is that the Fed becomes political, they cut short rates too much, and everybody says, you know what, we're off to the races in terms of government debt, we're off to the races in terms of inflation. That would cause the long-term rates to go up.
Well, we already did that. That's exactly what we did in 2020 and 2021.
We've got a 4% long bond 10-year yield. That is not high. If we lost Fed independence, it would go much higher. If we had more inflation, it would go much higher. And the other thing that I think is important here is the fact that we only got one dissent to this decision makes me more confident that all this talk about not reappointing the Fed presidents, that's not going to happen. The Fed as an institution has a lot of strength if it holds together, and I think it will maintain its independence and and try to be apolitical. It's not a Republican Fed, it's not a Democratic Fed. They really want to do the right thing by the economy, and the fact that there was only one dissent today, I think really suggests that they will be able to do that. So I think it's very positive for markets and actually will help hold down long-term rates.
Fair enough. I just wonder, Jim, and we've all been doing this a long time, okay? You've got AI that's sitting out there We don't know what that's going to do to the labor market. We have a labor market that was wildly overinflated during COVID because companies overhired. They were terrified of what's going to happen. They held on to employees. We saw 10-year yields go to what? Under 1%, David, as the Federal Reserve left its foot on the gas. I hope we can all agree, way too long. Way too long. How much visibility, Jim, do you have and your team have on the American economy right now, given the cloud of AI? I have no idea what the economy is going to look like in 5 years.
Yeah, so it's a good point. So effectively what we're going through right now is a CapEx-driven cycle. We have
$500 billion to AI infrastructure alone.
A lot, right, a significant amount. We haven't seen this since the 1990s, right? So many people in the markets haven't even seen this. We have a CapEx-driven cycle. You asked about small caps. You were talking about that. Look at non-farm, look at the small business confidence levels. Small business confidence is going up. Mid-sized company confidence levels are going up. The reason is that you're starting to get labor at a reasonable price. Labor is coming into the market, so the participation rates are moving higher. CapEx, AI, which is really driving the CapEx cycle, and it's driving a lot of the economy. Workers are going to start to come in 2026, and they're going to come in with labor costs relatively stable and low. For companies, that's a positive. I can't emphasize this enough. This is driving margins higher, which is why equities are where they are today, and they're able to look through all this noisiness in the market today. So what does AI do? Nobody really fully knows, but it probably leads to higher productivity. Better growth, lower inflation, higher margins, supports a higher multiple.
Yeah, Steve Leishman still in D.C. Maybe you can expand a little bit on that, or by the way, just whatever you want, because I hope the point is well taken that coming out of COVID and then going right into kind of the age of AI, how much do the Federal Reserve officials that you talk to almost every day, either publicly or privately, express concern to you that it is harder now to gauge the economy? Because I don't know, maybe they do, what the ultimate impact of things like artificial intelligence, like robotics, like those things are going to be on the American economy.
When I talk to Fed officials about AI, they say, put it on the list, Brian, for things that we're uncertain about. We haven't talked about the impact of immigration on the job market. The job market may be perfectly healthy given the immigration levels that we have, even though the Fed is looking at downside risks here. I think, by the way, that's something that stayed the hand of some Fed officials that are saying maybe we shouldn't be cutting more than one other time this year because of the idea that we may be at a break-even rate of 20, 30, 40,000 a month, maybe the right number given what's happening on the immigration side. AI would add to immigration, would add to tariffs, and you can see a line in the statement that it says the economic outlook is uncertain or highly uncertain. I want to pick up on something David said, which I think is really important. The idea that Bowman and Waller did not vote with Myron on a dissent for 50, I think is very important. It does underscore that at least those two officials are more interested in the institution, in the independence, than they are in getting the job. I think that's a big thing, because what we've seen in the past, Brian, is you have a Fed official who dissents and they make their dissent known, and then they come back into voting with the consensus. We've seen that a lot. One other thing that was not mentioned around the table, which is we're now in a position for the data to do a whole lot of talking here. If the economy weakens further, the Fed is probably well positioned here. The market is probably well priced. If it doesn't weaken further, then I don't know that I would be on the board with saying we'll get another 50 basis points. As we remember, we're running 3.3% on GDP on the tracking for the Atlanta Fed. So I think there needs to be some considerable weakness to lock in that additional 50 basis points this year.
So a couple of headlines here. And Francis, I want to reiterate to our audience, there's a lot of information coming out very quickly, that 7 members of the Fed said no more rate cuts this year. And I think 1 called for 1 more, 2 called for 1 more. That doesn't sound like a Federal Reserve that's like, let's just lower rates all year long. Woo, party's on.
Well, it's not a proper easing cycle as we might have think of it. I'm also wondering.
Could be one and done.
I'm wondering.
Could it be one and done?
What is the reason to do one and done in the first place?
Get the president off your back?
A signal, and I'm going to agree with Steve here. We are heading into a period where we're likely to see the job market is going to stabilize at lower levels that may be more structural than demand based for right now. And I'm still very concerned about inflation upswings into year end. This idea that tariffs haven't come through into CPI yet, so they won't, I think is very misguided. So this is going to be a challenge for this Federal Reserve to continue with an easing cycle or even a normalization cycle, as I might say it, when the data is not going to be working in their favor on either side of the mandate.
7 calling for no more cuts. I think they call that the dot plots. Maybe the lights have turned out on that Fed light bright, as I have referred to it. Jim, David, Francis, really appreciate your insight. Let you get back to your day jobs. Thank you very much. All right, let's now get a read on the stock market reaction. Dom Chu, I know all the attention's on the NASDAQ, the Mag 7. I get it. I hope you heard my point earlier about small caps. Suddenly now, Bobby Brady is the star of the show.
All right, so here's what I'm going to tell you guys. If you look at the markets right now on your screen, what you are seeing is a general positivity in the Dow so far, but an S&P and NASDAQ that are now below where they were before the Fed rate cut announcement came out. And just to kind of give you an idea of a benchmark, if you will, if you look at an intraday chart of the S&P 500, just before the decision came out, we were at roughly 6,600. Right now, the current price, as you can see, is 65.87, so 13 points below where we were before the numbers came out. It got as high as 66.24 in the 2 or 3 minutes right after the announcement. So it's gone up 24 points from there and given up all those 24 points and then lost another 10 to 13. That's the current state of play. So a bit of a roller coaster as we try to figure things out. Some key parts of the market to watch. Always on a Fed day, you're watching what the banks are doing right now. So take a look at the big ones like JP Morgan, Bank of America, Citi, Morgan Stanley, Goldman Sachs, all generally still higher, but maybe losing a little bit of steam. Also check out what's happening with the home building stocks. They are holding on to most of their gains. They did spike up after the rate announcement came out, but the likes of Lennar, D.R. Horton, Pulte Homes, even the Home Depots and the Lowe's are in play right now. So we're seeing generally green across the screen there. The other point that you made, Brian, about the Mag 7 type stocks, large cap, mega cap technology and communication services. That's a little bit more of a mixed picture right now. Apple shares are still clinging to a 0.25% gain. Microsoft and Nvidia lower on the day so far. And then we'll round things out with a check on gold prices, Bitcoin and Ethereum as well. They have generally been seen as reacting to this rate picture. And by the way, each of those assets, crypto and regular gold, all lower so far right now, Brian. So we'll keep an eye on the volatility as we head towards the press conference. I'll send things back over to you.
Dom, looking at the stock market reaction. Now let's get the bond market reaction in Chicago. Rick Santelli, not a huge move in the 10-year today, but I would imagine you're going to tell us that the move we've seen in the last couple of weeks has been the anticipation of what we got today, or no?
Well, let's get to that. Let's start first with the 2-year. 2-year was around 353, up 3 basis points on the session when the announcement hit. You could see it traded down on the intraday chart to 346. The current low yield close for the year was on the 8th of September at a 348 yield. So we are technically guns hot for a new high yield close, and that goes back to September of 2022. The 10-year that was just referenced, the last 6 or 7 sessions, it's been like compressing right around that 401 to 404 area, going nowhere quickly. The big story on 10s is the 4% threshold. Now, we have violated a bit. Right before the statement, we were at 404. So basically, 2s and 10s each moved about 5 basis points. We're hovering right at 399. We traded down to 398. But the reason 10 years are so important is because if we start to close the day or a week especially is a high priority technical signal under 4%. That would be very significant. Right now, we're still seeing basically white noise, not a convincing performance under 4%. We are at the lowest yield close of the year at 4% from the 4th of April. And finally, the dollar index is the big mover on the session, and nobody's talked about it. The dollar index is down about 1/3 to 1/4 of a cent since the announcement. It's on pace for the lowest close going back to February of 22. And all things considered, I think you want to really pay attention to the 2s-10s spread. It initially steepened. Now it's back to 51. Without steepening, maybe we could trade a bit under 4%, although I'd bet against it. Back to you.
That dollar index is a big deal. Keeps going down. To your point, maybe not enough talk about it. Rick Santelli, thank you very much. All right, now let's get a trader's take. Joining us now, Steve Grasso, contributor, CEO of Grasso Global, somebody I will see on Fast Money tonight.
That is correct. Looking forward to it.
We're both going to schlep into New York after this show. It didn't look like the Federal Reserve hit the panic button.
They did, and you wanted to check a box. And you know, there were dissents last time around. We had Bowman and Waller.
They didn't dissent this time.
They didn't dissent this time, but that was the first time last time in 30 years that there were dissents. So I think this time they didn't want to dissent because they already got their quarter point.
They said their piece.
And they got a quarter point. They were looking for a quarter point. The environment changed. And then we had Stephen Myron. He dissented. So we do have someone who wants 5 cuts. We do have others that were happy with the 25 basis point cut. But it depends on where the neutral rate is. So if the neutral rate is around 3 to 375, we're still very tight in monetary policy.
So let's get into that a little bit, because our job, again, Steve, is to look forward. I know we're going to look into next year, right, when Jerome Powell is replaced. No dissent because Bowman and Waller, to your point, got their 1/4 percentage point cut.
Right.
Stephen Myron wanted to cut the Fed funds rate by 0.5%. He was way out there to this point.
Right.
But you're talking about a guy that might become the chair of the Federal Reserve, or someone like him could become the chair of the Federal Reserve. Where do we see Fed funds rates a year from now?
Yeah, I think you're going to look for Fed funds rates to be around 3%. And I think that's what's really going to move the housing market or unlock the housing market. Do you know 85% of mortgage holders have a rate below 5.5%?
They're not going to move unless that rate narrows considerably. They still might pay more than they are now, but it can't be 3% more.
Correct. And when you think about it, we don't live in houses. We live in mortgages. We own mortgages, not the house. So in 2021, in January 2021, people wound up refinancing their mortgage rates. They got it below 3%. I think you were one of those guys probably, right? No?
I'm the one who didn't.
That's right. So if you think about it, you need to unlock the housing market. 5.5% unlocks the housing market because we're going in the general right direction. I think that's a big thing for the markets.
So the move we're seeing, so small caps, the Russell 2000 guys, bring up the RTY, I think is the ETF for the Russell 2000. That's up 1.9%. Dom Chu hit some of the housing stocks. And it's interesting because like the Lennars and the D.H. Hortons of the world, they're moving up a little bit today, even though bond yields aren't moving down. You're saying it sounds like, because, again, the market's looking out 6 to 9 months.
The market always prices 6 to 8 months ahead of what we're seeing now. So everything that we're seeing, everything in the market, they're already pricing stuff that we have no idea what is coming down the pike. Think about the Russell, though. 40% of the Russell is unprofitable. That means that they rely on interest rates. That means they rely on variable rates.
That is their margin.
That is their margins. So if you think those things are going to do better, think about tech investment. Those will do better. Consumer discretionaries, your Best Buys, your Home Depots, Ford, GM, anything that you will finance will do better with lower rates, obviously.
We got Richard Claret on the way. How much, like GM's had a nice move, because, again, how much of this is already priced in? Because the market's not waiting for the Fed.
Yeah.
If everybody said, well, we're going to get a cut, they're going to move GM and Ford and everybody's stock weeks ago, months ago.
Yeah. So I'm on record with thinking 25 basis points gave the market what it needed. 50 basis points would have created an incredible rally. 0 would have created a sell-off.
Can I ask you to stick around, joining this conversation?
Right here.
Hit Fast Money. We both go the same way. Let's bring in now a former Fed official's take. That is Richard Claret, a former Fed chair and global economic advisor at PIMCO. Richard, kind of a dealer's choice. You got the actual Fed decision everybody expected. You got Myron calling for a 0.5 percentage point cut. He's kind of way out there. No dissents, the neutral rate. What do you think is the most important thing here?
Well, I think there was some risk management here along 2 dimensions. One, the statement made reference to risk in the labor market. I think that was the primary motive for the cuts. But I think Jay Powell did some risk management on his committee. There was some thinking going in. You could have some dissents in favor of no cuts. On the other hand, you could have multiple dissents in favor of 50 or more. So a pretty close call if you just look at the dots in terms of the numbers supporting the total of 3 cuts. But it would have been a very interesting meeting to be a fly on the wall. We'll have to wait 5 years to get the transcript.
Yeah, I get the hyperbole. No dissents from Waller and Bowman, probably because, to Steve Grouse's point, they got their quarter point cuts, so you're not going to dissent against the thing which you were arguing for at the last time. What do you make of Myron's position? Calling for a cut of 0.5%.
Well, I think that was my expectation. And in fact, there had been some discussion that he might vote in favor of a 75 basis point cut. Obviously, it's his first meeting. He just got sworn in, so we don't have much to go on. But no, I wasn't surprised that he dissented in favor of a bigger cut.
And then what do you make, very quickly, Richard, of 7 people calling for no more cuts this year? If you're super dovish, that's not exactly a dovish Fed.
Indeed. In fact, again, we've had commentary from Fed officials, including 2 voters, Mr. Schmidt and Mr. Muslim, that indicated some skepticism about further cuts. And so whatever divisions were on the committee between hawks and doves, I think largely remain coming out of this meeting.
Richard, how do you square it when you look at tariffs where they could be that one-off price increase that Waller has argued, and then you look at the cracks in the labor market? Obviously, if you have a job, you can pay higher prices. If you don't, you can't. The answer to higher prices are higher prices. Where do you come down on that?
Order filled.
Well, I think that some of the tariffs are being absorbed not by consumers, but by exporters or corporations. We're also seeing some improvement on the services side of the economy. So I think the Fed has formed a judgment that they are sufficiently confident that there are not going to be these second round effects on inflation. When coupled with a softer labor market, I think Powell has the quorum that he needed to get the rate cut and the signal of more rate cuts in.
So what do you want to hear then from the last few meetings of Jay Powell? I think he's got 5 meetings where he is the chair. After this meeting, don't at me, it's 4, 5, or 6, one of the 2. But his term is coming up.
Yeah.
So, Richard, what would you like to hear from the Fed chair? What would the market like to hear over the next few meetings?
Oh, my. Well, I think there are a lot
of... Go to your oh, my?
Well, where do I begin? I think they'll want to hear about his views about, the independence of the Fed. They'll want to hear about his views about the balance sheet. They'll want to hear about his thinking about, the risk to the labor market and to inflation. And so certainly there will be 4 or 5 more press conferences, and he'll have plenty to talk about in the remaining months of his term.
Yeah. Steve, what's your take from a stock market perspective? Again, hit more on this on Fast Money tonight, 5 p.m. Eastern. Tune in. As long as I'm here, I'm going to just keep doing that.
Yeah.
Sure. But we're not seeing everything move higher, and we got a rate cut. I thought stocks were supposed to boom.
25 basis points were factored in. 50 would have surprised the market to the upside. And when you really think about it, if they did nothing, the market would be cascading lower because it was already factored in. So
if we didn't get the cut, we'd be probably talking about a Dow down a ton.
Yeah, and do we still have Richard? So I'm going to do that. Bring that guest back in. So Richard, you brought up the balance sheet. So when you look at the balance sheet, where it ballooned to $9 trillion, and I looked at pre-financial crisis, we were below $1 trillion balance sheet. Now you see it balloon to $9 trillion. Now we're below $7 trillion. How can they still allow MBS to roll off and still be cutting? So you have that push-pull to me, and that MBS rolling off has the most inflation, if you will, upward price momentum on your mortgage rates. So it seems like there's a push-pull. They're doing counterintuitive things. Where do you come down on that?
Well, it is a push-pull, and indeed it's been a push-pull now going all the way back a year ago. Remember, we got 50 basis points almost exactly a year ago and another 50 the remainder of 24, and yet the QT program continued. You see something similar at the Bank of England. They're doing QT and cutting rates, and so this is really where we are in this cycle. Central banks, certainly including the Fed, want to get towards a smaller balance sheet. We may be coming towards the end of that process at the Fed in the coming year or so. But sure, this has been a fact of life in markets now for at least a year.
Yeah, and just a reminder to our viewers, we're looking at the podium. Jerome Powell tends to be exactly on the nose with time. So 2:30:00 Eastern time, he tends to walk out. Ahead of that, the setup, small cap 600 up 1.8%. Russell 2000 up 1.3%. Bitcoin, by the way, down about 1,400%. the market. We're not seeing a big move in bonds. 10-year yield at 4.02%. Steve Grasso, where was it before the Fed decision? 4.02%.
Yep.
So the move in the last couple of weeks, again, the market is not waiting around. The bond market is actually going to run the show. Richard Clarida, PIMCO, really appreciate your time. Richard, thank you very much. 20 seconds, Steve Grasso, final comment.
Yeah, I think you hit it on the head before. If you're looking to May 2026, where Jerome Powell leaves his post, there's going to be a lot of doves that are released between now and then. The market's going higher.
I think, a wise man once said, this is what it sounds like when doves fly, right? Because I don't think the doves are going to be crying anytime soon. Richard Clarida, thank you. Steve Grasso, we'll see you tonight on Fast Money, 5 p.m. And as we noted, right on time, Jerome Powell.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. While the unemployment rate remains low, it has edged up. Job gains have slowed and downside risks to employment have risen. At the same time, inflation has risen recently and remains somewhat elevated. In support of our goals and in light of the shift in the balance of risks, today the Federal Open Market Committee decided to lower our policy interest rate by 0.25 percentage point. We also decided to continue to reduce our securities holdings. I'll have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that growth of economic activity has moderated. GDP rose at a pace of around 1.5% in the first half of the year, down from 2.5% last year. The moderation in growth largely reflects a slowdown in consumer spending. In contrast, business investment in equipment and intangibles has picked up from last year's pace. Activity in the housing sector remains weak. In our summary of economic projections, the median participant projects GDP to rise 1.6% this year and 1.8% next year, a touch stronger than projected in June. In the labor market, the unemployment rate edged up to 4.3% in August, but remains little changed over the past year at a relatively low level. Payroll job gains have slowed significantly to a pace of just 29,000 per month over the past 3 months. A good part of the slowing likely reflects a decline in the growth of the labor force due to lower immigration and lower labor force participation. Even so, labor demand has softened, and the recent pace of job creation appears to be running below the break-even rate needed to hold the unemployment rate constant. In addition, wage growth has continued to moderate while still outpacing inflation. Overall, the marked slowing in both the supply of and demand for workers is unusual. In this less dynamic and somewhat softer labor market, the downside risks to employment appear to have risen. In our SEP, the median projection for the unemployment rate is 4.5% at the end of this year and edges down thereafter. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer-run goal. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.7% over the 12 months ending in August, and that, excluding the volatile food and energy categories, core PCE prices rose 2.9%. These readings are higher than earlier in the year as inflation for goods has picked up. In contrast, disinflation appears to be continuing for services. Near-term measures of inflation expectations have moved up, on balance, over the course of this year on news about tariffs, as reflected in both market and survey-based measures. Beyond the next year or so, however, most measures of longer-term expectations remain consistent with our 2% inflation goal. The median projection in the SEP for total PCE inflation is 3.0% this year, and falls to 2.6% in 2026 and to 2.1% in 2027. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to lower the target range for the federal funds rate by a quarter percentage point to 4 to 4.25%, and to continue reducing the size of our balance sheet. Changes to government policies continue to evolve, and their effects on the economy remain uncertain. Higher tariffs have begun to push up prices in some categories of goods, but their overall effects on economic activity and inflation remain to be seen. A reasonable base case is that the effects on inflation will be relatively short-lived, a one-time shift in the price level. But it is also possible that the inflationary effects could instead be more persistent, and that is a risk to be assessed and managed. Our obligation is to ensure that a one-time increase in the price level does not become an ongoing inflation problem. In the near term, risks to inflation are tilted to the upside and risks to employment to the downside, a challenging situation. When our goals are in tension like this, our framework calls for us to balance both sides of our dual mandate. With downside risks to employment having increased, the balance of risks has shifted. Accordingly, we judged it appropriate at this meeting to take another step toward a more neutral policy stance. With today's decision, we remain well positioned to respond in a timely way to potential economic developments. We will continue to determine the appropriate stance of monetary policy based on the incoming data, the evolving outlook, and the balance of risks. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate, based on what each participant judges to be the most likely scenario for the economy. The median participant projects that the appropriate level of the federal funds rate will be 3.6% at the end of this year, 3.4% at the end of 2026, and 3.1% at the end of 2027. This path is 1/4 percentage point lower than projected in June. As is always the case, these individual forecasts are subject to uncertainty, and they're not a committee plan or decision. Policy is not on a preset course. The Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission, and we at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to our discussion.
Great. Thank you. Chris Rugaber at Associated Press. As you know, Fed Governor Stephen Miron has kept his position at the White House, even as he's joined the Fed board. This is the first time, I believe, the Fed's board has had someone with executive branch ties in decades. Does this compromise the Fed's independence from day-to-day politics? And relatedly, how can you maintain the public's perception the Fed is politically independent with this dynamic? Thank you.
So we did welcome a new committee member today, as we always do, and the committee remains united in pursuing our dual mandate goals. We're strongly committed to maintaining our independence, and beyond that, I really don't have anything to share.
Okay, and then just as a quick follow-up, I'm sorry, can you and other Fed officials have spoken extensively about the impact of tariffs on inflation, although perhaps with many companies appearing to eat the tariffs, tariffs may be impacting the labor market and other parts of the economy instead. Do you see that as a possible outcome here, that tariffs are the reason we're seeing some slowing, particularly in the labor market, rather than in inflation? Thank you.
You know, it's certainly possible. You know, we're beginning to see, we have begun to see goods prices showing through into higher inflation, and actually the increase in goods prices accounts for most of the increase in inflation, or perhaps all of the increase in inflation over the course of this year. Those are not very large effects at this point, and we do expect them to continue to build over the course of the rest of the year and into next year. And you know, it's also possible that there may be effects on employment, but That, I would say if you're looking at why employment is doing what it's doing, that's much more about the change in immigration. So the supply of workers has obviously come way down. There's very little growth, if any, in the supply of workers. And at the same time, demand for workers has also come down quite sharply. And to the point where we see what I've called a curious balance. It's, typically when we say things are in balance, that sounds good. But in this case, the balance is because both supply and demand have come down quite sharply. Now demand coming down a little more sharply because we now see the unemployment rate edging up.
Nick Timrose of the Wall Street Journal. Chair Powell, do economic conditions and the balance of risks no longer warrant a restrictive policy setting?
So I don't think we can say that. What we can say is this, that over the course of this year, we've kept our policy at a restrictive level, and people have different views, but a clearly restrictive level, I would say. So, and we were able to do that over the course of this year because the labor market was in very solid condition with strong job creation and all those things. I think if you go back to April and now look at the revised job creation numbers for May, June, July, and August, I can no longer say that. So what that means is that the risks were clearly tilted toward inflation. I would say they're moving toward equality. Maybe they're not quite out of equality. We don't need to know that. But we do know that they've moved meaningfully toward greater equality, the risks between the two goals, and that suggests that we should be moving in the direction of neutral, and that's what we did today.
Under what circumstances would a larger than 25 basis points rate cut be warranted, and how seriously was that option entertained at your meeting this week?
There wasn't widespread support at all for a 50 basis point cut today. I think we've done very large rate hikes and very large rate cuts in the last 5 years, and you tend to do those at a time when you feel that policy is out of place and needs to move quickly to a new place. That's not at all what I feel certainly now. I feel like our policy has been doing the right thing so far this year. I think we were right to wait and see how tariffs and inflation and the labor market evolved. I think we're now reacting to the much lower level of job creation and other evidence of softening in the labor market and saying, well, those risks are maybe not fully balanced, but moving in the direction of balance now. And so that warrants a change in policy.
Colby Smith for the New York Times. Should we be viewing today's cut as the committee taking out some insurance against the possibility that the labor market is at risk of weakening? Or is it the committee's view that the dynamics of a downturn are already in place? I guess I'm just trying to square the shift in the rate forecast in the SEP towards more cuts than just 3 months ago with the fact that the forecast for unemployment didn't change.
Yeah, I think you could think of this in a way as a risk management cut, because if you look at the SEP, actually, the projections for growth this year and next actually ticked up just a little bit, and inflation and unemployment didn't really move much. So what's different now? What's different now is that you see a very different picture of the risks to the labor market. You've seen, we were looking at 150,000 jobs a month at the time of the last meeting, and now we see the revisions and we see the new numbers. And I don't want to put too much emphasis on payroll job creation, but it's just one of the things that suggests that the labor market is really cooling off. And that tells you that it's time to take that into account in our policy.
So just looking at the SEP, once again, the median participant has inflation higher than previously expected by the end of next year, and the Fed not getting back to the 2% target until 2028. So I guess I'm just wondering how you characterize the risk to price pressures of kicking off a series of cuts at this point.
Yeah, so I would look at it this way. We fully understand and appreciate that we need to remain fully committed to restoring 2% inflation on a sustained basis, and we will do that. At the same time, we've got to weigh the risks to the two goals. And I would say since April, to me, the risks of higher and more persistent inflation have probably become a little less. And that's partly because the labor market has softened, GDP growth has slowed. So I would just say that the risks there have been less than one might think. And And in terms of the labor market, what we're seeing is unemployment is still low. It's still a relatively low rate, but we're seeing downside risks.
Michael McKee from Bloomberg Radio and Television. I'm a little confused by your explanation of the Fed cutting rates because of unemployment. If you think that most of what's happening in the employment area is related to immigration, which your rate cuts wouldn't address, how do you see that as more important than inflation, which has remained almost a full percentage point above your target?
Well, I was saying that what's happening in the labor market has more to do with immigration than it has to do with tariffs. That was the question I was answering. So I wouldn't say that all of what's happening in the labor market is due to tariffs. I mean, you clearly have a slowing in it due to immigration. You clearly have a slowing in demand, which is now perhaps more than that in supply, and we know that because the unemployment rate has ticked up. So, that's what I meant by that.
We can follow up. Every year since 2015, the SEP has forecast that you would hit your target 2 years later. And this year, this SEP says you're going to hit your target 2 years later. 2% does not seem to be in sight. Does that suggest that the 2% target is not really achievable? And does this present any credibility problems for you in telling people that that's what you're going to do if you can never reach it?
Well, I mean, you're right. It does say we're going to get to 2% inflation in 2028, at the end of 28. But that's literally how you put the projections together. You're writing down a rate path, which is designed to create, over the course of the SEP, time frame, 2% inflation and maximum employment too. So that's all that is. No one really knows where the economy will be in 3 years. But the nature of the exercise is to write down policy that you believe would return to the 2% goal over at least by the end of the exercise.
Thanks so much, Elizabeth Schulze with ABC News. The latest inflation report shows that prices are still going up across key categories for many households, including groceries. What will the Fed do if prices pick up more?
So our expectation, and you can see this consistently through the year, has been that inflation will move up this year, but that basically because of the effects on goods prices from tariffs, but that those will turn out to be a one-time price increase as opposed to creating an inflationary process. That's been our forecast. Pretty much all the individual forecasts say that. We can't just assume that, though, right? We have to. Our job is literally to make sure that is what happens, and we will do that job. Right now, the situation we're in is that we see inflation. We continue to expect it to move up, maybe not as high as we would have expected it to move up a few months ago. The pass-through of the tariffs into inflation has been slower and smaller. The labor market has softened. So the case for there being a persistent inflation outbreak is less. And so that's why we think it's time for us really to acknowledge that the risks to the other mandate have grown and that we should move in the direction of neutral. So what will we do? We'll do what we need to do, but we have two mandates and we try to balance them. For a long time, our framework says that when our two goals are in tension, and this is quite an unusual situation, how do we decide what to do? Because our tools can't do two things at once. What we do is we ask which is farther from, how far is each from the goal and how long is it expected to get to the goal? So, and then we think about those things and we see, as I mentioned, our policy had been really skewed toward inflation for a long time, really. Now we see that there's downside risk clearly in the labor market, and so we're moving in the direction of more neutral policy.
How concerned are you about the slowdown in the jobs market for households at home, especially younger Americans struggling to land a job?
So it's an interesting labor market, and obviously we think it's appropriate that we reduce our rates so that we become more neutral, which presumably will be better for the labor market. You see people who are sort of more at the margins, so kids coming out of college and younger people, minorities are having a hard time finding jobs. The overall job finding rate is very, very low. However, the layoff rate is also very low. So you've got a low firing, low hiring environment. And the concern is that if you start to see layoffs, the people who are laid off there won't be a lot of hiring going on. So that could very quickly flow into higher unemployment. In a healthier economy, healthier labor market, there would be jobs for those people. But now the hiring rate is very, very low. So that's been a growing concern over the last few months. And it's one of the reasons why we think it's appropriate that we begin to shift our policy focus toward a more balanced one.
Steve Leisman, CNBC. Mr. Chair, in the past, during rate cuts, you used the word recalibration. And I wonder if you pointedly did not use it this time. And in fact, when you said policy is not on a preset course, did you mean that as sort of the opposite of recalibration? Are we meeting to meeting, data point by data point? Are we in the process here of getting back to neutral? Thank you.
So I think we're in a meeting by meeting situation. We're going to be looking at the data. Let me say a word about the SEP really here. So we often point this out. What the SEP is it's an accumulation of the individual projections of 19 people, showing what they believe at a particular moment in time to be the most likely path for the economy and thus the appropriate path for monetary policy as well. And as you know, we don't debate or try to agree on what that is. We just write them down and accumulate them. We do sometimes discuss them. And so we always say we're not on a preset path, and we really mean that. The actual decisions we make are going to be based on the incoming data, the evolving outlook, and the balance of risks at the time the decisions are actually made. So you will have seen that we have 10 participants out of 19 who wrote down 2 or more cuts for the remainder of the year, and 9 who wrote down fewer than, in fact, in a good number of cases, no more cuts. So rather than looking at this as certainty, I would encourage people, as always, to look at the SEP as through the lens of probability. And so there are different possible outcomes and likelihoods rather than this one is certain and this one isn't happening. So that's what I would say.
Thank you for getting to my follow-up question, which was, is the dispersion in the outlook a sign of uncertainty of policy in the meetings to come? Thank you.
You know, it is such an unusual situation. Ordinarily, when the labor market is weak, inflation is low. And when the labor market is really strong, that's when you got to be careful about inflation. So we have a situation where we have two-sided risk. And that means there's no risk-free path. And so it's quite a difficult situation for policymakers. And it's not at all surprising to me that you have a range of views. It's not so much about having different views for the path of the economy, but it's partly that. But it's also partly about what's the right thing to do in light of the tension between the two goals. How do you weight them? How worried are you about one versus the other? And so it's natural. I think it would actually be surprising if you didn't have a pretty wide range of views based, in this kind of highly unusual situation, and we do. So, but we get together, we discuss, we have a great discussion, and then we decide what to do and we act. But you're right that it's a wide dispersion of views, and I think that's understandable and natural in the current situation.
Hi, Victoria Guida with Politico. You've talked a lot about Fed independence and the importance of it over the years, but as markets have questions about what exactly President Trump's intentions are with the Fed, what would you point to as the things they should be watching to determine that the Fed is still making decisions based on, the economic outlook rather than political considerations?
Look, it's deeply in our culture to do our work based on the incoming data and never consider anything else. That's just everybody who's at the Fed really feels strongly about that way. So, you'll know it by the way we talk about what we're doing, by the speeches that people give, by the decisions that we make. You'll know that we're just still going to do that. That's all we do. And we don't frame these questions at all or see them in terms of political outcomes. I think when you get to another part of Washington, everything is seen through the lens of does it help or hurt this political party, this politician. That's the framework. And I think people find it hard to believe that that is not at all the way we think about things at the Fed. We're taking a longer perspective. We're trying to, serve the American people as best we can. So I think you would be able to tell. I don't believe we'll ever get to that place. I would say we're doing our work exactly as we always have now, and they're making their arguments, and we're having a great discussion around these challenging issues. So,
do you see the court case around Lisa Cook as being related to questions of Fed independence?
I see it as a court case that it would be inappropriate for me to comment on.
Thanks, Mr. Chairman. Edward Lawrence from Fox Business. So we saw the preliminary benchmark revisions down 911,000. The revisions for June were the first negative revisions we've seen since December of 2020. How can the Fed base important decisions on rate and what to do with the interest rates on data that seems to be, as you've called it in the past, noisy?
So on the QCEW, the revision that we saw was almost exactly what we expected. It was amazing how close the expectation was. So, and the reason for that is, for the last bunch of quarters, there's been almost a predictable overcount, and I think the Bureau of Labor Statistics really does understand this, and they're working hard to fix it. It's got to do, of course, it has something to do with low response rates, but it's also got to do with what's called the birth-death model, because a good amount of job creation happens around new companies and how many go out of business, how many are founded. And it's just really hard. You can't survey for that. You've got to have a model that predicts that. And it's quite difficult to do, especially when the economy is undergoing big changes. So, and they've been working on that and are making progress on it. But the data we get is still good enough for us to do our work. To the extent we have issues around data right now, it's about low response rates. That's happened all over really. Response rates are just lower to surveys now, both in and out of the government. And it's no great secret. We want higher response rates, and we need those to have, less volatile data. And the way to get that is to make sure that the agencies that collect the data have sufficient resources to drive higher response rates. It's not a complicated problem, but that's what it takes. It's not a mystery. That's what it takes. The other thing I'll say, Edward, is in the case of the job creation, the response rate is quite low for the first month, or lower for the first month. By the time you get to the second or third month, you're still collecting responses for that last month, for that prior month. And you get to the place where the data are much more reliable by the second and certainly the third month. So it's not that we don't get the data, it's just that we get it a little later.
But for the benchmarks, if that holds, it's 51% of the jobs that we thought were there weren't really there. Shows a weaker job market coming into this year. If you had that information, would it have changed your mind related to where the interest rates should be? Should there have been a cut earlier?
We have to live life looking through the windshield rather than the rearview mirror, as you know. And all I can tell you is we see where we are now, and we take appropriate action, and we took that appropriate action today.
Thanks. Howard Schneider with Reuters. So as you mentioned a minute ago, some margins of the job market would suggest that the slide's already happening. A black unemployment rate in August was above 7%, declining work week, difficulty among college graduates finding work, rising youth unemployment. Why do you think a quarter percentage point now is going to arrest that?
Well, I didn't say that I thought a quarter point would make a huge difference to the economy, but you've got to look at the whole path of rates, right? And the market's has already been baking in expectations. I mean, our market works through expectations, right? So I think our policy path really does matter. And I think it's important that we use our tools to support the labor market when we do see signs like that. I did mention that, you see minorities, unemployment going up, you see younger people who are more vulnerable economically, more susceptible to economic cycles. That's one of the reasons, in addition to just overall lower payroll job creation, that shows you that at the margin, the labor market is weakening. I would also point to labor force participation. Some part of the significant decline in labor force participation over the last year has probably been cyclical in nature rather than just the usual aging process. So we put all those together, And we see that the labor market is softening, and we don't need it to soften anymore, don't want it to. So we use our tools. And, it starts with a 25 basis point rate cut. But the market's also pricing in a rated path. I'm not blessing what the market's doing at all. I'm just saying it's not just one action.
As a follow-up to that, the growth mix right now seems very concentrated in investment and on the consumer spending side in the higher income groups. Do you feel that that's an unsustainable mix for the economy moving forward?
I wouldn't say that. I mean, you're right. Those are two. We're getting unusually large amounts of economic activity through the AI build out and corporate investment. I don't know how long that will go on. No one does. In terms of spending, you saw that the consumer spending numbers were well above expectations, and that may well be skewed toward higher earning consumers. There's a lot of anecdotal evidence to suggest that. Nonetheless, it's spending. So, I mean, I think the economy is moving along. Economic growth is going to be 1.5% or better this year, maybe a little better. Forecasts have been coming up, as you can see. So, labor market unemployment is low, but downside risks, but it's still a low unemployment rate. So, that's how we see it.
Hi, Stephanie Rule, MSNBC. Treasury Secretary Scott Bessent has said that the Federal Reserve suffers from mission creep and institutional bloat. He's now calling for an independent review. Would you support an independent review, or are you open to any sort of reform in any areas of the Fed?
I, of course, am not going to comment on anything the Secretary says or really any other officer says. So in terms of reform at the Fed, we just went through a lengthy and I think very successful process of updating our monetary policy framework. I would say there's a lot of work going on behind the scenes around the assets we have in the Federal Reserve Federal Reserve System and at the board. Are they the right size? We're actually going through a 10% headcount reduction through the whole Fed, including the board and all the reserve banks. The employment at the Fed at the end of that will be basically at the same level it was more than 10 years ago. So we will have had zero job growth for more than a decade when we're finished with that, and I think we'll probably do more than that. So I think we're certainly open to constructive criticism and ways to do our jobs better.
But not an independent review?
We're certainly open to always trying to do better.
Mr. Chairman, Neil Irwin with Axios. There's been some debate lately on whether AI is already starting to affect the labor market in terms of lower labor demand, higher productivity by contrast. Do you buy that? And if that is true, does that have implications for the monetary policy setting?
So there's great uncertainty around that. I think my view, which is also a bit of a guess, but widely shared, I think, is that you are seeing some effects, but it's not the main thing driving it. And so particular focus on young people coming out of college. And yeah, there may be something there. It may be that companies or other institutions that have been hiring younger people right out of college are able to use AI more than they had in the past. That may be part of the story. It's also part of the story, though, that job creation more broadly has slowed down. The economy has slowed down. And so it's probably a number of things. But yeah, it's probably a factor. Hard to say how big it is.
Thanks, Mr. Chairman. What evidence do you see of tariffs showing up in inflation?
Well, if you can take goods, just sort of the broad goods category, and last year, goods inflation was negative. If you go back 25 years, that was the typical thing, was that goods inflation was, goods prices generally went down, even adjusting for quality. So that was not the case during the pandemic, of course. Goods inflation went very high, but we had essentially returned to zero or slightly negative inflation. Now, I think goods inflation over the course of the past year is 1.2%, which doesn't sound like a lot, but it's a big change. So we think, I mean, analysts have different views, but we think it's contributing, 0.3 or 0.4 or something like that to the current core PCE inflation reading, which is 2.9%. So it's contributing. What seems to be happening is that, the tariffs are mostly not being paid by exporters, mostly being paid by really the companies that sit between the exporter and the consumer. So if you buy something and you sell it through retail or you use it to make a product, you're probably taking a lot of those costs on and not able to pass it fully along to the consumer yet. That appears to be what we're seeing. All of those companies and entities in the middle, they'll tell you that they have every intention of passing that through in time, but they're not doing that now. To the consumer, the pass-through has been pretty small. It's been slower and smaller than we thought. But the evidence it's very clear that there's some pass-through.
I also wanted to ask if you could share with us the conditions under which you might consider leaving the Fed in May.
I have nothing new on that for you today.
Hi, Katerina Saraiva with Bloomberg News. I just wanted to follow up on one of your answers just a couple minutes ago. We've often heard you talk about how you and your colleagues, do not think about politics. This does not enter the room. But one of your new colleagues does come from this world, right, where everything is seen through this framework of politics and of what party is being helped, and that person is still employed by the White House. How can markets and the public interpret, some of his speeches, for example, and then some of the forecasts that we see today? I mean, the median for this year was moved because of the introduction of his forecast. I'm talking about the number of rate cuts seen this year. What do you say to markets and the public that are trying to interpret, what you guys are saying?
So there's 12 vote, 19 participants of whom 12 vote, as you know, on a rotating basis. So no one voter, can really. The only way for any voter to really move things around is to be incredibly persuasive, and the only way to do that in the context in which we work is to make really strong arguments based on the data and one's understanding of the economy. That's really all that matters, and that's how it's going to work. And I think that is the way the institution, that's in the DNA of the institution. That's not going to change.
And then I wanted to ask about a Gallup poll that showed that Americans now have more confidence in the president than the Federal Reserve when it comes to doing what's right for the economy. Why do you think that is, and what's your response? What's your message to the public?
Our response is we're going to do everything we can to use our tools to achieve the goals that Congress has given us, and we're not going to get distracted by anything. So I think that's what we're going to do. We're just going to keep doing our jobs.
Claire Jones, Financial Times. Given the range of views expressed prior to the meeting, I think there was a lot less dissent today than a lot of people expected. It'd be good to know just what you think the drivers were of coming to that very strong consensus in the meeting, and also on the flip side to just explain why the dot plots are really so scattered between, someone even expecting rates to end up higher by the end of the year to 5 cuts. I mean, what were the kind of range of views you heard about, on one side, why there was so much support for a cut today, and on the flip side, why there's so much divergence about what comes next?
So I think there's quite a wide assessment that the situation has changed with respect to the labor market. Whereas we could still say, and did say in July, at the time of the July meeting, that the labor market was in solid condition, and we could point to 150,000 jobs per month and many other things. I think that the new data that we've had, and it's not just payrolls, it's other things as well, suggests that there really is meaningful downside risk. I said there was downside risk then, but I think that downside risk is now a reality, and there's clearly more downside risk. So I think that's broadly accepted. And so that meant different things for different people. Some wrote down, almost everyone wrote down, supported this cut, and some supported more cuts and some didn't, as you will see from the dot plot. So that's just the way it is. You have people who take this work very seriously, think about it all the time, do their work, discuss it with our colleagues. We endlessly discuss this between ourselves, and then we have a meeting where we put it all out on the table, and this is what you get. And you're right, there's a range of views in the dots, and I think that's, like I said, very unsurprising given the quite unusual, historically unusual nature of the challenges that we face. But let's remember, though, the unemployment rate's 4.3%. The economy's growing at 1.5%. 50,000, 200,000 a few months ago. It's come down quite significantly, and that's because a very lower amount of people are joining the labor force. The labor force really not growing much at this point, and that's a lot of where the supply of labor was coming from over the last 2 or 3 years. So we're not getting that now. We've got much lower demand. It's interesting that supply and demand have really come down together so far, except now we do have unemployment ticking up outside, just one tick outside of the range where it's been for a year. 4.3% is still a low level, but I think this level of this speedy decline in both supply and demand has certainly gotten everyone's attention.
Follow up, if I may. You mentioned the downside risk to employment a fair amount, but it's striking that measures of kind of activity and output for the third quarter, those that we have, seem pretty strong. The Atlanta Fed's GDP now is very strong. You mentioned strong PC numbers as well. How do you square those things? Is there a chance actually could be upside risk to the labor market if those activity measures are right?
Well, that would be great. We'd love that to happen. So I don't know that you see a big tension there, but it's gratifying to see that economic activity is holding in, and it's a good bit from consumption. It looks like consumption was stronger than expected. What we got earlier this week, I guess. And also we're getting a fairly narrow sector is producing a lot of economic activity, which is the AI build out and business investment. So we watch all of it, and I would say we did move up. The median for growth for this year actually moved up in the SEP between the June and September SEPs. So, and really the inflation and labor market didn't change much. It's really the risks that we're seeing to the labor market that were the focus of today's decision.
Nicole. Hi, Nicole Goodkind with Barron's. Thank you for taking my question. Given the cumulative impact of high interest rates on the housing sector, I'm wondering how concerned you are that current rate levels are exacerbating housing affordability issues and potentially hindering household formation and wealth accumulation for a segment of the population?
Housing is an interest-sensitive activity, so it's at the very center of monetary policy. When the pandemic hit and we cut rates to zero, the housing companies were incredibly grateful, and it was really, they said that was the only thing that kept them going, was that we cut so aggressively and provided credit and things like that, and they were able to finance because we did that. The other side of that is when inflation gets high and we raise rates, and you're right, it does burden the housing industry, and so rates have come down a bit, and as that happens, we don't set mortgage rates, but our policy rate changes do tend to affect mortgage rates, and that has been happening, and that'll of course raise demand. Lower borrowing rates for builders will help will help supply, and so some of that should happen. I think most analysts think that it would have to be pretty big changes for it to matter a lot, big changes in rates to matter a lot for the housing sector. And the other thing is by achieving maximum employment and price stability, that's a strong economy. That's a good economy for housing. And then the last thing I'll say is, there's a deeper problem here. There's not a cyclical problem that the Fed can address, and that just is a pretty much nationwide housing shortage. Or a lot of places in the country just don't have enough housing for people, and all of the areas around metropolitan areas like Washington, for example, are very built up, and so you're having to build farther and farther out, and so that's where it is.
And just a quick follow-up. During the last SEP, or the press conference following the last SEP, you seemed to indicate that policymakers lacked conviction about their projections, and I'm wondering if you still feel that way.
Forecasting is very difficult even in placid times, and as I've mentioned before, forecasters are a humble lot with much to be humble about. So I think right now is a particularly challenging time, even more uncertain than usual. And so I don't know any forecaster anywhere, really. Ask any of the forecasters whether they have great confidence in their forecast right now. I think they'll honestly say no.
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. If you're cutting rates, why continue to reduce the size of your balance sheet, then pause the unwinding?
Well, I think we're cutting the size of our balance sheet quite marginally now. As you know, with the balance sheet, we're still in an abundant reserves condition, and we've said that we would stop somewhat above somewhat above an ample reserves level. That's where we are, and we're getting closer to that. We're monitoring it very carefully. We don't think that has at all significant macroeconomic effects. These are pretty small numbers moving around inside a giant economy. The level of runoff is not very large, so I wouldn't attribute macroeconomic consequences to that at this point.
And at his recent confirmation hearing, Stephen Myron brought up that the Fed actually has 3 mandates from Congress, not just jobs and stable prices, but also moderate long-term interest rates. So what does Congress mean by moderate long-term interest rates? How should we understand that when we see the 10-year Treasury moving? And how do you think about this part of the mandate when policy choices like rate cuts or balance sheet reductions affect the long end of the yield curve?
So we always think of it as the dual mandate, maximum employment and price stability, for a long time, because we think moderate long-term interest rates are something that will result from stable inflation, low and stable inflation, and maximum employment. So we haven't thought about that for a very long time as a third mandate that requires independent action. So that's where that is. And there's no thought of, as far as I'm concerned, there's no thought of considering that we somehow incorporate that in as something in a different way.
Thanks, Chair Powell. Matt Egan from CNN. We recently learned that average FICO credit scores are down this year by 2 points, the most since 2009 during the Great Recession, and delinquencies are high for car loans, personal loans, credit cards. How concerned, if at all, are you about the health of consumer finances, and do you expect today's cut will help?
So, we're aware of that. I think default rates have been kind of ticking up, and we do watch that. They're not at a level, I don't believe they're at a level where overall they're terribly concerning, but it is something that we watch. Lower rates should support economic activity. I don't know that one rate cut will have, a visible effect on that, but over time, a strong economy with a strong labor market is what we're aiming for, and stable prices. So that should help.
Just to follow up, this rate cut is coming at a time when the stock market is at or near all-time highs, and some valuation metrics are elevated historically. Is there a risk that cutting rates could overheat financial markets, potentially fueling a bubble?
We're tightly focused on our goals, right? And our goals are maximum employment and price stability. And so we take the actions that we take with an eye on those goals. Separately, And that's why we did what we did today. Separately, we monitor financial stability very, very carefully. And, I would say it's a mixed picture, but households are in good shape. Banks are in good shape. Overall, households are still in good shape in the aggregate. And I know that people at the lower end of the income spectrum are under pressure, obviously. But from a financial stability perspective, we monitor that picture. We don't have a view that there's a right or wrong level of asset prices for any particular financial asset, but we monitor the whole picture, really looking for structural vulnerabilities. And I would say those are not elevated right now.
Jean, we'll go to you for the last question. Hi, Chair Powell. Jean Young with M&I Market News. I wanted to ask about inflation expectations. You've said the Fed can't take the stability of inflation expectations for granted. You mentioned at the short run they've gone up a little bit. I wonder if you can talk a bit about that. And then also at the long run, wondering, do you see evidence that the debate over Fed independence and the growing deficit is putting pressure on inflation expectations?
So as you said, shorter-term inflation expectations have tended to respond to near-term inflation. So if inflation goes up, inflation expectations will predict that it takes just a little while to get back down. Fortunately, throughout this period, longer-term inflation expectations, both break even in the markets and almost all of the longer-term surveys, Michigan being a bit of an outlier lately, have been just rock solid in terms of running at levels that are consistent with 2% inflation over time. So we don't take that for granted. We actually assume that our actions have a real effect on that, and that we need to continually show and also discuss our commitment to 2% inflation. And so you'll hear us doing that. We're, as I mentioned, it's a difficult situation because we have risks that are both affecting the labor market and inflation. Those are our two goals, and so we have to balance those two. When they're both at risk, we have to balance them, and that's really what we're trying to do. Your latter part of your question was about independence. I don't see market participants. I don't see that that's something they're factoring in right now in terms of setting interest rates. Thanks very much.
All right, that was the Fed chair explaining why the Fed just cut interest rates by 25 basis points. Its first cut in a year. Chair Powell saying the balance of risks have shifted towards more weakening in the labor market. Much talk about potential dissents today. We got one from newly appointed Fed Governor Stephen Miron. He wanted a 50 basis point cut, and we're going to discuss that and more in just a bit. Let's take a look at stocks, too, as we enter the final stretch today. They are largely mixed. The Dow's been higher for most of the day, NASDAQ lower. It is the Russell that is outperforming today, about 1% or so from an all-time high. Also important to look at rates. The curve steepening, a little volatile there as well. The long end has been the focus. The 10-year went briefly below 4%, but you see now has risen above that, and we'll get into that as well. It's good to welcome you to Closing Bell today. I'm at Double Line in Los Angeles with Jeffrey Gundlach, the firm's founder, CEO, and CIO. It's good to have you, and thanks for having us.
Welcome to Double Line, and I calculated that we've been doing this, you'll be surprised. This is our 37th time that we've done this in relation to the Fed, which is, it feels like a lot less than that, but that's the way time goes, especially when you get older.
Yeah, and we've had a lot to talk about, obviously, in that stretch.
Yeah, it's been all over the place.
Yeah, give me your reaction to what you got today, to what the Fed chair himself called a risk management cut, as he suggests the risks have grown.
Yeah, I think the phrase of this press conference is challenging situation and no risk-free path forward. I think what really surprised the markets a little bit, and what led to some of the reversal on what was lower interest rates and what the stock market, was that when he said there was no support or very little support for a 50 basis point cut. Because I know the chatter going into this meeting was a lot about maybe they'll go 50, but it sounds like that wasn't even a consideration. And he also said, which he says pretty much every press conference, there's no predetermined path for interest rates. I thought Steve Leisman asked an interesting question about the word recalibration disappeared. frankly, he didn't say recalibration, but I think there was recalibration. And, I always talk about the spread between the Fed funds rate and the 2-year Treasury, and it was getting pretty out of whack. It wasn't like it was a year ago when it was the most out of whack in my career, but it was out of whack, and so the 25 is there. Very divided opinions about what should happen for the rest of the year.
To say the least. I mean, I'm wondering what you make of that. I mean, there is huge disagreement. So one member wanted 5 more 25 basis point cuts. We can only assume that that's Mr. Myron. Sure. 6 project no more, and 9 see 2 more. So there's massive disagreement.
All over the place.
What do you make of that?
Well, I think it ties in with Jay Powell's comments about the labor market. He seemed genuinely surprised or confused, maybe is a better word, about the 1.7 million job revision downward. And the most recent one, 918,000, which are really big revisions. And he seems a little bit confused also about how the labor market has shrinking supply and demand. And I'm a little bit concerned that the consequences of this path downward from about 120, 150 job creations a month down to maybe 0 to 50, I think he gave the range. I think there's a risk there of over-easing. I hope that they start focusing, and I think they will if I read carefully into what Jay Powell said. They need to look at the unemployment rate more than the jobs creation. It always used to be the jobs creation. But now with this negative immigration and with the downward shift in demand for jobs, supply for jobs, I think we really need to focus on the unemployment rate, which he rightly says is not terribly elevated at 4.3. There's that old SOM rule about the unemployment rate versus its moving average, and it's not triggering. It's not over 0.5 above its 12-month moving average.
As Ms. Som said this morning on CNBC,
No, did she?
not quite triggered. So she's matching exactly what you believe too.
There are 2 important indicators that are not high frequency. They have long lead times. And one of them is the unemployment rate versus its 36-month moving average. And it's above its 36-month moving average. And that's usually leads by a lot, but it's been above its 36-month moving average for a long time. And yet, no recession yet. Also, the yield curve, 2s to 10s, when it crosses above its 12-month moving average, you're really on watch for a recession. But when the 12-month moving average itself goes above 0, which it has on the 2s, 10s, that's has a good record of predicting that you're getting near the front edge of recession. And, Jay Powell it's interesting that the SEP, they increased marginally the expectations for growth, yet he sounds much more cautious about things with the confusion about the unemployment rate and the birth-death model he brought up, which a lot of economists that have been wary about the economy have been talking about flaws in the birth-death model, and he kind of acknowledged that today. And that's the primary reason in his mind for the downgrade in the past reports of the jobs created.
If you are worried to some degree about the Fed over-easing, do you agree with the 25-point move today? Do you think that was the right move, and do you think 50 would have been a mistake?
Yeah, I think 25 is the right move. Again, it's getting more in sync with the 2-year Treasury. But I do think that it's interesting that the yield curve, it started out by steepening, and now it's flattening. And I think that's in response to the rhetoric about 50 was not even being considered. The long bond, as I've been talking about really for the past over a year in these conversations, the long bond doesn't really want the Fed to be easing a lot. The long bond likes it when the Fed has inflation more under control, and the long bond obviously doesn't like the budget deficit increasing. We're almost all the way through fiscal 2024, which ends at the end of next month, and the budget deficit as a percent of GDP is higher than last year, which was higher than the year before, which was higher than the year before that, which is all very surprising because we had so much stimulus back then. So what's really out of control is spending. Government spending is out of control, and I think the 3B bill that's coming into effect. I think that has too much spending in it, and I don't like the tax cuts either.
Hang on just one second. Steve Leisman's made his way out of the room, and we'll come back with Jeffrey, of course, in just a minute. So, Steve, as you read the statement and you heard the Fed chair, and then, of course, you asked your question, is the biggest story today the massive disagreement, as we've termed it, over the outlook for the remainder of 25? Is that the biggest takeaway among others?
Well, Scott, let me correct you. The correct economic term for disagreement on the Federal Reserve is dispersion of views, just so you know.
Thank you.
And that's a joke, of course. I'm guessing Jeff understood that one. Anyway, where we are is you had 7 folks who didn't want just either one more cut or no more cuts, and you have 9 who want 2 more cuts. And the way Powell explained it was like, hey, with all the stuff that's going on right now, you would think we would have a dispersion of views or a debate. In fact, that's exactly what I asked him about. But before we get to that quote, which I want to run here, I said, is this a recalibration or is this meeting by meeting? And he said, it's meeting by meeting. We're going to have to see the data. And then he talked about this exact question that you asked about, Scott.
Ordinarily, when the labor market is weak, inflation is low. And when the labor market is really strong, that's when you got to be careful about inflation. So we have a situation where we have two-sided risk, and that means there's no risk-free path. And so it's quite a difficult situation for policymakers. And it's not at all surprising to me that you have a range of views.
Now, I think we went into this, Scott, with really one question, which is, we knew a cut was going to happen. How much confidence can we have in the future cuts? I'm looking at the futures market, Scott, and I'm seeing that they're pretty much dialed in those other 2 rate cuts out there. I don't know if it's more or less than they should, but certainly Powell did not use that word recalibration, which is what he used in September 2024, forecast additional cuts. We're looking now at January 2026. So that's pretty dialed in, that 360, which is, right, by the way, right on where the median Fed funds or Fed official is right now. So I do think there's some doubt that should be in investors' minds, Scott, only because if inflation goes a little hotter and jobs are a little stronger, maybe you get just one more cut.
I also have felt, Steve, over the last few meetings at least, that the chair himself has had an air of confidence about him and where the Fed currently is and how it views the outlook and where they feel like they are. I feel like today you just have reintroduced a level of uncertainty around things that we really haven't felt in a while, to the degree that the Fed chair himself said it's not entirely clear what to do at the end of the sentence where he started, there's no risk-free paths now that you mentioned.
Yeah, I mean, I kind of disagree a little bit, Scott. I think Powell is pretty comfortable with the uncertainty around it. It's like, hey, I was dealt, a 2, a 3, a 4, and an 8, or something like that. There's no actual obvious hand here to think about, in the sense that you have, and I've said this a bunch of times, unprecedented challenges on both sides of the mandate. Let me give you an example, Scott, and this is something that we're going to need to talk about in the future. If the break-even rate of employment is, let's say it's 50,000 now, and your 95% confidence level around that number is plus or minus 100,000, that means you could be minus 50K and have an okay job market if those numbers are the right numbers. So I think he's like, hey, this is what I got. I got unprecedented challenges on both sides. I have a committee, they're expressing themselves, and he's going through the process. I don't think he's any more uncertain with the situation than he's been. He's just in a very uncertain situation. Seems pretty comfortable for me in that situation.
All right, good stuff, Steve. I appreciate you. Thank you. That's Steve Leisman, just out of the room, of course, asking a question himself to the Fed chair. We're back here in Los Angeles with Jeffrey Gundlach. Do you agree with that assessment from Steve?
Largely, I do, yeah. I mean, I think there is a remarkable divergence of views at the Fed. I mean, one guy, the new guy, wants 5 cuts between now and year end. I think that's a little bit disturbing for the inflation outlook when we think about that it's quite possible, if not likely, that Trump is going to replace Jay Powell with somebody else. And based upon this action today, of this 5 cut way out in left field, you wonder if you're not going to be running a more inflationary policy. And so it's not surprising to me that the 10-year couldn't stay below 4% and that the long bond gave it up as well, because that's not a long way away, May. It's not a long way away. And if we end up getting somebody that's going to run a very low interest rate policy, this is going to be extremely challenging for bond investors. Also, relative to the bond market, something I'd like to point out, for a long time now, we've been having the bond market supported by decent treasury yields, and then on top of that, spreads for credit products. But the treasury yields have been falling in recent weeks fairly a lot. And now we're getting to the point where the treasury yield plus the spread on some of these products like investment-grade corporate bonds is no longer getting to the yield bogeys that, say, insurance companies want to invest their money for their fixed-rate annuities, which have become popular. And this may end up putting, if the treasury market rallies, and I'm not really convinced that it's going to rally further, but if it does, I don't think credit's going to keep up, because a lot of these buyers that have been supportive of credit, which has been extremely stable, other than the tariff tantrum earlier in the year, they've been solving for their yield bogey, and it's going to be harder to get if treasury yields fall further unless spreads widen out. So I think there could be some pressure on credit spreads as we move forward.
I've asked others this question, and you sort of allude to it. I'm wondering, is this, in your estimation, the last best chance to take advantage of some things in credit as a result of what you fear could be a super dove, so to speak, in the big chair?
I think credit is fairly expensive. I don't think there's it's clear, it's just a statistical fact that 2 years ago, credit was incredibly cheap. You had very high interest rates, you had wide spreads on credit, and that was the opportunity. I think now the biggest opportunity to be looking for is a continuation of the trend of the lower dollar, which I think it may have. I think it dropped sharply on the cut, but then it rebounded. But if you look at, as well as assets the United States have done this year, I mean, bonds, low risk bond portfolios that are intermediate, like benchmarked against the Bloomberg Aggregate Index, it's easy to be up over 7% year to date in a low risk sense. And then you go to, the stock market's done really well. Foreign stock markets for dollar-based investors, which was a very strong recommendation of mine for the year 2025, have just done phenomenally well. I mean, they're up in the 20s for dollar-based investors, with the currency translation being so powerful. I just think that the dollar is going to be continuing to decline, with foreign investments in the United States has now reversed after 18 years of huge inflows from foreign investors, over $20 trillion. That's reversed in the most recent data. And I think that's going to continue, and that will put downward pressure on the dollar. Also, hedging costs for foreign investors are down, and so there'll be selling pressures perhaps on the dollar going forward. I continue to believe that non-U.S. investing for dollar-based investors is a strong recommendation, and that goes right along with gold, which has just been ridiculous over the last 2 years, up over 100%, up 45% year to date. And now even the gold miners are getting involved, which suggests to me that retail investors are starting to join the momentum trade on the gold market. I remember I suggested that gold would go to 4,000.
I was just going to ask you about
by year end. I think we got up to about 3,700. I think almost certainly gold will close above 4,000 before the end of this year.
So there are a number of things in that. I want to go back to the idea of higher inflation as a result of what's taken place in terms of the makeup of the Fed and how it may continue to evolve in the months ahead. Because there is a view that what the president's done to the Chair Powell, or what the things that he said, and Mr. Myron's presence now as a Fed governor will in fact lead to higher inflation. It sounds like you agree with that.
I think there's risk of higher inflation, and Jay Powell, he didn't dwell on this in his remarks, but he certainly referenced the idea that inflation is rising and it's under upward pressure. And so I think that the inflationary outlook is very uncertain. Jay Powell is correct in stating that we don't really know what the tariff effect, when it's going to kick in, what it's going to be. It's obviously not going to be non-zero. And in spite of the fact that the energy complex has done nothing, I mean, the crude oil has been in this 60 to 65 range for a long time. Commodity prices are going sideways, and yet gold is going crazy. I think that is a reference to the weaker dollar, which has to have something to do with higher inflation. Our inflation model, like many others, and like the price fixing in the market, really looking for a 3 handle on the CPI to end this year, maybe even as high as 3.3 on the CPI. The PCE, they always use that one. It's lower and better contained. But I think the risk of higher inflation should not be discounted or dismissed, certainly.
Does that mean that you would continue to avoid the 30-year, for example, which you've maintained with me on multiple occasions was not a place to be?
Yeah, well, it's certainly been the right place, the right idea. I mean, since the Fed started easing a year ago, the long bond is down now about 8% on a total return basis, and I think that there's a lot of risk there. There's going to be, I think, one of the penultimate question in the press conference was something about the dual mandate. Now they're talking about a third mandate, which is moderate interest rates, and I think they mean long-term interest rates. I think it's interesting that that's joining the conversation, because I believe that it's possible that there will be a yield curve control that becomes implemented if interest rates go too high on long-term treasuries. One thing, to answer your question specifically, we are only thinking of increasing our exposure down the curve and decreasing further our exposure out the curve. In some of our funds where we have futures capabilities, we actually have been short the 30-year Treasury bond and getting the duration instead on intermediate and shorter-term bonds by being long 2-year Treasury contracts, and that's worked very well. I mean, the 230 spread has gone out from inverted out to as high as about 130 basis points. It's settled in now at about 115, but I believe that that's going to continue until such time as interest rates are deemed to be too high for economic purposes. And I think most importantly is housing affordability. Housing affordability is very poor. Even with interest rates having come down, there's work at the Atlanta Fed that looks at what percentage of the median household income has to go to paying for your home, your mortgage, the insurance, the PMI if you have it, and all that. And it's gone up by about 20 percentage points what it takes. So the median household income, now the mortgage and the home ownership cost is 48% of median household income. And in urban areas, it's really outrageous. I saw a statistic today that in the Los Angeles metropolitan area, which is Los Angeles, Anaheim, and Long Beach, amazingly, the median home payment is 90% of median household income. And the way things are going, it might even go to over 100, which sounds like crazy, but it just shows that there's so many people that can't afford a home. I think it's possible that they try to manipulate interest rates to get mortgage rates down, and that would be in anticipation of that. One has to be constantly mindful that that type of manipulation could cause a reversal in this yield curve steepening situation. I think the yield curve will naturally keep steepening until it gets manipulated. And given that the new Fed member is outrageously calling for 5 cuts at the next 2 meetings, it shows the extent to which, let's generously call it creative thinking, is being entertained by the administration and the evolving construct of the Federal Reserve.
Do you have a favorite in mind of the names that have been out there publicly on who you would be comfortable with as the next Fed chair?
I haven't really thought about it, quite frankly. I think the list is really 3 people. I think they've sort of tipped the hand on that. I don't think I would. I'm not really fond of the ones that are going to be the most malleable. But I do think the job interview, given the operation of the Trump administration, I think the job interview is going to be, will you do what I tell you to do? And if the answer is no, I think you're not going to be Fed chair. And so this is what I'm worried about with the inflationary policy. As we get towards the next Fed chair, I do think it's going to be almost a negative real interest rate type of situation. We have interest rates that are below the inflation rate.
I mean, if you strongly feel like that's likely to happen, what's the fattest pitch right now
Local currency, emerging market debt in local currency, which has started to perform very well. But I think that's the number one play on the weaker dollar, which remains one of my strongest convictions. And the dollar is basically rebounded off its lows today, but it was at the low of the year. I think it was lower than any time since 2022. And so it is interesting that with the dynamics that have been going on, typically you'd expect a stronger dollar, but instead we have a weaker dollar. When the S&P sold off earlier this year, almost always the dollar rallies when the S&P sold off. Not this time. The dollar actually went down by about 8% when the S&P sold off.
Well, because you've had the president himself talk about wanting a weaker dollar.
Yeah, I mean, when you run negative interest rates, if you're going to do that, negative real interest rates, you're running an inflationary policy, and that's going to lead to, I think, a weaker dollar.
What does that mean for stocks?
Well, stocks have priced in, as has the bond market, a lot of rate cuts. And one thing I've been struck by is how every time there's talk of more interest rate cuts, or that an interest rate cut is coming, the stock market rallies day after day after day, just on the same hope. Like the 50 basis point hope was, I think, exaggerated by investors, that they thought maybe we get a 50, and maybe that's what we got the last several percentage points up in the stock market. But I don't really like U.S. stocks as a dollar-based investor. I've felt that way all year, and I continue to feel that way. You're really better off in non-dollar markets, and they are all up similar amounts. There's some dispersion, but there's similar amounts on an index basis. But when you translate the currency, you end up with tremendous results out of some of these stock markets. I mean, I think, and also bond markets, like the Mexican bond market for dollar-based investors is up like 35% year to date.
But you've been a big proponent of India, and you've said it with me for at least a couple of years, I feel like now.
That's a little bit on pause, because that's one currency that's not appreciating. It doesn't appreciate versus the dollar. So this Indian stock market has not benefited from currency translation like the European stock markets have.
Well, I was also going to ask you about these sort of renewed tensions, or not even renewed, just new.
Yeah,
between our administration.
That's a setback for the Indian stock market for sure. But the Indian stock market is it's a long-term play. It's one that's zero trading, just long, and don't worry about it, because the economic reforms are required to absorb all of the population that is entering the labor force, hundreds of millions. They need to restructure things the way China had to do it to absorb their huge influx of workers into the labor force that's now gone the other way. So China makes no sense for U.S. investors. There's too much tensions with China. I don't know what would happen if the market went up a lot. You might not be able to get your money out. If it goes down, you're going to own it. I just don't like the risk-reward mix there at all. India has such favorable fundamentals and a strong history of good economic leadership actually over time, and I think it's going to return to that situation.
I've often asked you as well, like, what does the perfect portfolio for the moment feel like? Have you been thinking more about that lately, and how would you answer that for our viewers who are thinking the same thing?
Yeah, I really haven't changed very much. I'm still think gold serves a purpose in portfolios. It's at a high level on a short-term basis, but the momentum is remarkable. I love it when a market goes up a lot and then instead of correcting, goes sideways for a while. And that's what gold did. It got up to about 3,300, and then it consolidated there, and now it's on an up leg. I still think a 25% type of weighting in portfolios of gold is not excessive. I think that...
Really? 1/4 of one's portfolio in gold?
Yeah, I think it's not excessive. because I think that is an insurance policy, and it's in a winning mode because of the weaker dollar, and I believe that's going to continue. So a lot of my perfect portfolio concepts revolve around weaker dollar. So foreign stocks, European stocks make sense. I think some Asian stocks, ex-China would make sense, and you do it in local currencies. So I have a big anti-dollar theme that's going through things. And like I said, for bond portfolios, I think local currency emerging markets, I think having 10% there makes some sense. I would have probably 40% in stocks, mostly, if not entirely, non-U.S., as I've suggested.
Even with the AI theme and the trend of where that is, the tremendous advancements that are taking place, you wouldn't have any exposure or such minimal exposure to U.S. stocks like those? When new technologies come, there's the sky's the limit, but it gets priced in very quickly. And I use the analogy of electricity. In 1900, people started to realize that electricity was going to change the world, and they were right. And so there was a mania in electricity stocks that actually peaked out in 1911 before there was really widespread electrification. It was all priced in. And in fact, since 1911, if you look at U.S. stocks, everything other than electricity-oriented stocks, and then you just look at electricity stocks, the non-electricity has outperformed since 1911. So it gets priced in very, very early. And the AI build-out is enormous. But it seems a lot like kind of the fiber optic stuff back in the late 1990s, where it's very real, it's happening, it's going to be world-changing, but the markets are incredibly efficient at pricing things in and often overdo it. So I am not a momentum person at all, unless there's a fundamental reason, and momentum driving things to very high valuations. If there's one thing that makes me not sleep at night is owning stuff like that, and that's just me. For some people, they'll make a fortune on it, but I think the fortunes have largely been made. What do you think of these crypto treasury strategies that have become pretty popular, I would say, in the last handful of months, and some very high-profile people, well known to our viewers, and certainly in the investing world, the Tom Lees of the world, Dan Ives, and others who are taking advantage of that? What do you think about that?
Yeah, every few years, there's something that comes up that's kind of a gimmick. And, I remember Portable Alpha, I remember 3130 strategies. I think that a lot of these things are sort of gimmicky. And so I wouldn't be involved in that at all.
And because of, are you concerned about the volatility in Bitcoin and Ethereum? And if there's a major correction of some sort, those are the kinds of assets that would be hurt the most?
Probably that's right. But I don't spend a lot of time thinking about that. I'm not a big crypto person at all, and I notice that Bitcoin has underperformed gold this year, and that's pretty remarkable given how everything's up so much. So I don't really think that Bitcoin is a very good investment. I know that people have made a fortune in it, but it's lost its momentum, and I just don't think that it's going to serve the purposes that are hoped for.
My last question, will we get a cut, do you think, at the next meeting, right before we talk to you next?
Yeah, I think we'll get a cut at the next meeting. They seem to be, he doesn't say it in plain English, but they seem to be in cutting mode. And the 2-year Treasury is still 60 basis points below the new Fed funds rate. And that, to me, suggests that the odds are much better for a cut than for a hold at the next meeting.
All right. Well, we'll talk to you right after. We'll see exactly what happens.
38th time.
Yeah, I look forward to it. We'll have just as much to talk about, I'm sure, given where things are and where maybe we think they're going. Jeffrey, thanks so much for having us out here.
Thanks. Good luck, everybody out there.
It's Jeffrey Gundlach here at Double Line, live in Los Angeles. We'll take you into the closing bell market zone now. CNBC senior markets commentator Mike Santoli is with us, and Virtus Investments, Joe Terranova. We'd like to get their views. Joe, I'll just go to you first. Stock investor. What do you do now that you heard from the Fed and you've had a chance to listen to Jeffrey Gundlach's views as well?
think the big decision for an investor right now, Scott, is do you want to turn in the direction of the narrative where the rally broadens out? Do you want to trade down into small caps? Do you want to look at things like regional banks? Clearly, the indication is today, based on the price action, that in fact you could make somewhat of that turn. I'm still staying up in the equity size class with mid cap and large cap. But the ownership that I have of financials is proving to be a good one today in the wake of the Federal Reserve rate cut. We had a little bit of a sell-off before the 3 o'clock hour here on the East Coast, down to 65.51. Traders stepped in, they bought that dip, and they bought that dip really in the equally weighted S&P, not so much in the Mag 7.
Mike, that's going to dominate the conversation, I suppose, on programs going forward. Do you, now that you think that more cuts are coming, do you lean into the broadening trade versus the Mag 7, for example?
Yeah, I mean, it's funny, Scott, because there was an effort to front run that exact trade. I talked about it on halftime today, where it was sort of Russell was ripping, NASDAQ 100 was for sale. I mean, in a way, that's a mechanism for the market to rebalance itself a little bit here, because the only super overbought part of the market is mega cap tech. So maybe you can get away with just sort of rotating your way around it. I don't think too much has completely altered in terms of the outlook here, maybe less than people were hoping for, in the sense that Powell was still kind of, not dismissing inflation as a concern. It was relatively still kind of a balanced, contingent outlook. We are still going to have to pay attention to the data. Big picture, rates are going down, not up. The economy is still hanging in there. So those are the two premises that got the stock market to where it is right now. And unless and until the bond market really starts to register concern about longer term inflation, or if the economy is going to really start to run hot next year, then I think stocks can live with this and kind of feed off of the same themes. And even if it is about, a little bit of bumpy action in the near term, as we still contend with a little bit of a seasonal undertow.
Mike, what do you make of Jeffrey here talking about gold continuing its run? It's at high levels. He obviously admits that as he talks bullishly about it, but even suggesting that a quarter of your portfolio should be in that asset.
Obviously, then you're massively overweight gold if you have a quarter of your portfolio in it, because if you just look at the aggregate value of all financial assets. So many things are going in the direction of gold, and I think one of the things that it has going for it right now is it's sort of defying some of the things you would expect it to do. In other words, yes, the dollar is down. Yes, people are diversifying. Central banks are buying it. But it's not as if real yields are negative. It's not as if inflation is raging. It's not as if really macro stress is that high. So all those things that would otherwise be explanations for why gold is strong are not necessarily flagging it, and yet it's still in demand. So I think it's much more about don't fight the trend than it, to me, is about having a very coherent view of why it's doing what it's doing and playing, that into the future. So, I'm in the don't fight it mode.
Yeah. What about weaker dollar plays, Joe? If you believe that that's the direction for the foreseeable future, that the dollar is just going to continue to move lower, is it a multinational lean in that's going to be beneficial for their earnings? How do you see that?
Yeah, in fact, it is. It allows you to kind of think about diversifying geographically. And also, you have a stronger disinflationary trend for sure in Europe. It's one of the reasons why Germany is outperforming year to date and the emerging markets are outperforming year to date. So you have that opportunity to look outside. I think the dollar continues to move lower, and it gives multinationals the ability to do what the chairman spoke about and I found so interesting, and that's absorb the cost of the tariff. And Scott, if you think about the totality of 2025 and the rally we've had, it's really been the ability of corporations and the strong earnings to allow this market to levitate. And as long as those earnings are strong, they can continue to absorb the tariff.
Joe, what would you make of what we've been calling, really since the moment it happened, this massive disagreement about the outlook for rate cuts for the remainder of the year? And you as an investor having to decide which side of that debate, if you will, you're on, and to what degree you're on it. You may want to cut in the next meeting, but that's it. You may want to. I don't know. You tell me, and how that might influence your stock ideas.
I think it's a little bit troubling, especially as you turn the calendar into 2026. On halftime today, I suggested that we would get a 25 basis point cut and 3 dissents. Well, you didn't get 3 dissents, but there's a lot of dissension inside the Federal Reserve right now. So we go back to staring at the labor numbers more than anything else. The unemployment rate's going to be particularly important, but the path is, I think, a little bit more unclear today to investors than it was 24, 48 hours ago.
Mike, also, the one dissent we got is I could see some saying, well, that's way better than getting 3, because the one who dissented and has the outlook that we believe he has is the most of the outlier view relative to some of the others. So the bell rings here. We'll follow all that. Appreciate the coverage. We'll see stocks go out mixed here. The Dow is higher, as you see. S&P, NASDAQ are both negative, and the Russell 2000 coming off its best levels of the day as well. That does it for us. I'll see you back now into overtime with John Ford.
That bell marks the end of regulation. Garmin ringing the closing bell at the New York Stock Exchange. BR Partners doing the honors at the NASDAQ. And stocks are mixed after the Fed's decision to cut interest rates by 1/4 point. Check out the intraday chart of the S&P 500. Briefly popped into positive territory following the decision, slid as Chair Powell spoke, and recovered most of the losses. The yield on the 10-year also shifting. It fell at first, dipping below 4%, then moved higher. Similar chart pattern for the dollar index, down at first, then spiking higher. And gold did touch a new all-time high today before pulling back. Silver down nearly 3%. Copper also lower, maybe profit-taking after a rally. That's the scorecard on Wall Street, but winners stay late. Welcome to Closing Bell Overtime. I'm John Fort. Morgan Brennan is off today. Today's big story is the Fed and the market reaction. Got a great lineup of reporters and guests covering every angle, including one of the people in contention for a Fed seat. David Zervos of Jefferies, he said the Fed should cut by 75 basis points. We'll get to him in just a moment. But let's start with the market reaction to the Fed's decision. Our Christina Partsinevelos is here with a recap of today's action. Christina.
Well, the Fed cut rates and markets did exactly what you'd expect. Jump first and ask questions later. John, you talked about that. And after the initial euphoria wore off, we saw some selective moves. Starting with the Russell 2000 had, I would say, maybe the wildest ride out of all the indexes or indices. These smaller debt-heavy companies love rate cuts, and the index actually hit an all-time closing high before pulling back and closing 0.2% low higher, I should say. Home builders started strong, makes sense with the hopes of cheaper mortgages, but couldn't stick the landing. Both the ITB and XHB did close lower, over just about 1% in the red. Regional banks were the real winners today, up 1.5% roughly, snapping a 3-day losing streak. Larger names like Truist, M&T jumped mostly almost 2% higher. Rate cuts really boost loan demand while easing pressures on their funding costs. It's essentially a double win for these guys, but it wasn't all good news. NVIDIA did get hit after China reportedly blocked its AI chip sales to local tech companies. That dragged down Broadcom, other chip darlings as well. And then quantum computing, a surprise winner today. The Energy Department announced partnerships with IonQ, Honeywell for space applications. And then you also had D-Wave closing roughly almost 18% higher. That's the QBTS there, seeing a bump in quarterly revenue. They announced it at a conference in Tokyo, and that's why that sector is doing well. John?
All right. Christina, thank you. Now to the reaction we saw in bonds. Our Rick Santelli joins from Chicago. Rick.
Yes, John. You know, it was an exciting day, but after it was all said and done, interest rates weren't much different than they were, well, this morning. Now, if you look at 2s and 10s on the same chart, a couple things should jump out at you. First of all, 2-year traded down as low as 346. Its current low yield close for the year was just last week at 3.48%. So it doesn't look like we're going to make a new low yield close, considering we're hovering at 354, up 4 basis points. 10s, well, 10s traded down as low as, well, 398, but a U-turn there as well. The key is the low yield close of the year from early April is basically 4%. I don't think we're going to challenge that either. But the big mover, and maybe the big winner in many ways today, was the dollar index. There's a chart of the dollar index after the spread, which steepened. The dollar index had a great reversal. The lows of the session to where it is now is almost 3/4 of a cent bounce. And do keep in mind, yesterday's close was the lowest close going all the way back to Feb of 22. So a bounce here, well, it could be significant, but the weekly close on Friday needs to be above around 97.5, according to technicians, to really reverse some of the negative sentiment of the last several sessions. John, back to you.
Rick Santelli, thank you. A lot of bouncing around. Now let's get to Steve Leisman, just back from Fed Chair Powell's press conference. Steve.
Thanks, John. Fed Chair Powell explaining the rate cut today, but being careful not to promise too much more. Asked by CNBC if this was a process of recalibration, Powell in fact said it was decisions we made meeting by meeting and based on the data. The reason? Disagreements within the Fed over the outlook for policy and tension on both sides of the mandate between higher inflation and weakening labor markets.
Ordinarily, when the labor market is weak, inflation is low. And when the labor market is really strong, that's when you got to be careful about inflation. So we have a situation where we have two-sided risk. And that means there's no risk-free path. And so it's quite a difficult situation for policymakers. And it's not at all surprising to me that you have a range of views.
Check out this information about the committee being at odds here. One didn't want to cut it all today. 6 committee members want no more cuts after today's cuts. 2 want 1 more cut. 9 want 2 more cuts. And 1 individual, we think it's Stephen Myron, the new Federal Reserve Board governor who came from CEA chair. He wants 5 more cuts this year, or that person does anyway. Futures market trading, however, with confidence of those 2 additional cuts, maybe more confidence than Powell expressed. 90% for a cut in October, 80% for another one in December. The key to the outlook may be in the statement itself, which said that downside risks for employment have increased. And as long as that's the case, the Fed may be cutting rates until the inflation and employment mandates and the risks there are in balance, John.
Steve, when's the last time you had this kind of range of expectations for the future from the Fed?
I don't know, but it's pretty rare, I can tell you, because what we're talking about is the expectation for the end of the year, and there's only 2 more meetings left. So I'll go back and try to find this dispersion. But I will tell you, John, we made a joke in the press room today that we were going to need a letter pad in order to, a legal pad in order to get that new dot in there that we all expected to be as low as it ended up being.
All right. Steve Leisman, thank you. Well, a quarter-point cut was the vote of 11 of the 12 voters. The lone dissenter was brand-new Fed Governor Steve Myron. He wanted a half point. That's not as much as our next guest. Joining me now is David Zervos. He's chief market strategist at Jefferies and a CNBC contributor. He's been saying they should have cut 75 basis points at today's meeting. Hasn't met with the Trump administration about the Fed chair nomination. David, good to see you. So I'm trying to figure out how far off from the range are you here? 75 looks like a big number, but how many more cuts do you think are needed for the rest of the year after that?
Well, John, first of all, let me say, I talk about what I think should happen and what I think will happen. And I certainly was in the camp that they would only go 25. I didn't think this committee would come to it, but I've added some spice to what I usually say on this program and others with some of your other hosts and other hours, offering what I think should happen just because of this contention storyline for me. So I wasn't surprised by much of what Powell said. I thought he was actually kind of nervous about the labor market, a little more dovish than I thought. And I think where the market turned on him was the 50 discussion. Why wasn't 50 even discussed in any meaningful way? And I think the market expected that to be the case, and it just wasn't the case. And that's why you got the dollar ripping back up and the yields coming back up as well. The market is looking at this like maybe a small policy mistake, that we should be lower, we should be less restrictive. They're taking some undue risks on the employment side, and they have a lot going for them on the inflation side if that labor market forecast is weaker in the future. So I think the market reacted kind of right to that, and I think the Fed did sort of what you expected them to do, and I don't think there was much new here.
David,
as for
you talk about the market's reaction. Which reaction are you talking about? Because the market seemed to do a couple
of discussion of 50.
Right, but both the stock markets, we just heard from several of our journalists here at CNBC, both stocks and bonds made some moves in a couple different directions after the announcement and then the commentary, and then the S&P closed just off of flat.
I mean, look, at the end of the day, these are pretty
market is
unchanged
closed.
markets, as Rick was saying in the beginning from where we started the day. But I think the market was excited about a dovish Fed. They thought Jay sounded dovish. The statement talked about labor market weakness. They focused on labor market weakness. The balance of risks had moved. Everybody got excited. You take the 10-year to 398. You take the dollar in, euro dollar up to 119 and change. And then you listen to Jay. And then you listen to Jay and he says, we didn't even talk about 50. And the market turns it around and takes it back to unchanged. That's basically the story of the afternoon. Completely understand why the market did it. Kind of completely understand why they did the 25. I'm a little not unhappy, but I find the idea that we're not even discussing 50 to be a little bit of a silly idea. And I think the market reacted accordingly to that. When Jay was asked as well, I think Nick Timmerose asked him about, would you consider the 50s and how do you think about 50s? He might have made some argument that those are only in really special times and really unusual times, like during COVID or like during major crises of sorts, which doesn't really bode well for what he did back in September just before the election. So I think it's a little bit suspect why the 50 wasn't even discussed, and I think the market reacted to that.
Well, when we see what the different voting members of the Fed are expecting for the rest of the year, and I guess maybe more than just that, where do you fall on how many cuts? Because maybe you're saying you just think that a bigger cut is necessary up front, but you're more in line with the rest of the Fed governors on where we end up?
I guess the way I think about it, John, is most of the committee wants to get there. They seem to want to get there in the next 12 weeks. Why not get there sooner? Risk manage a little bit more to this unbelievable change in the labor market outlook after these two sets of revisions that we had, both the revisions recently and then the 2024 revisions that were seismic, really. Okay. So the whole model is basically thrown out. The immigration story is now being replaced with a productivity story. I think you go take out a bigger insurance policy and say, look, we're going to wait and see. But this was a very significant change in the labor market outlook. And by the way, Jay sounded like he thought it was a very significant change in the labor market outlook. So I don't really think you had a storyline that didn't warrant at least an active discussion of 50. So I think that's why the market was modestly disappointed. I would be happy to see 75 lower and then we just go meeting to meeting and watch it and see what the data says. Okay.
But he did say, though, that there's a two-sided risk. And so therefore, it makes it a tough call. You seem to be saying that the risk in the near term is not so two-sided. You think it's weighted much more toward labor market weakness. Am I hearing that right from you?
Well, I think so, John. Think about it this way, right? And he's saying we've got this labor market weakness. That was the surprise. The real surprise has been how weak the labor market has been. You've got that working on your side for inflation, right? That's now a headwind for inflation, meaning if we have a weak labor market, we would expect in all these models to suggest that there would be some disinflationary pressures or weaker demand. So you've got the new data, which is labor market data, probably telling you that you shouldn't be as worried about inflation. And in fact, Jay said to that point that he's less worried about inflation than he was back in April, May, June. So I think that risk balance is important. And I guess the other place I come sort of a little bit differently than maybe many on the committee would be that I just think neutral's lower. I think neutral is probably closer to 2 than it is 3. And the committee's still stuck in this 3, maybe 3.25 area. So I think we're actually probably more restrictive than many people think.
Well, back in the spring, to be fair, Chair Powell was probably more worried about inflation than you were. So for him to be a little less worried about inflation, maybe that's bringing him to that two-sided risk in a different way than you are. Now, he also said that tariff pass-throughs to consumers are present, but smaller than expected. Do you agree? Are you seeing those tariff pass-throughs to consumers, and might your outlook and opinion change if those get bigger than they are now?
I think we're all watching that, John. We're all watching how this inflation dynamic comes through, and it's definitely come through better than expected by the inflation hawks. The inflation hawks were very nervous and very concerned about significant pass-throughs and breakdowns in inflation expectation, meaning a de-anchoring, and we haven't seen that in the survey data or, more importantly, the TIPS data. So I think it's all gone much better from April to today on the inflation side than many would have expected. And the goods side has popped. But again, we're a service economy, and the service price storyline still seems very much intact with where it was back in April or even before that. And it's come down dramatically from those peaks that we saw in the 2021, 2022 era. So finally, I feel like the trajectory on inflation, I'm more confident on it than I've been. Okay. And it sounds like the Fed's more confident that it's not going to be a problem than they were even a meeting ago or certainly back in April.
Well, speaking of how the Fed is feeling, there's a wide dispersion of opinion about what should have been done in this meeting and what's going to happen next. Do you read that and what we can figure, perhaps as soon, was Stephen Myron's contribution as healthy for the Fed to have this wide range of outlook, or is it a sign of something unhealthy or chaotic?
Actually, I thought to me, it was a little bit more together than I would have expected. I thought there were risks, as many in the market thought, that we could see Chris Waller and Mickey Bowman move toward Stephen's camp for 50, and they didn't. They stayed kind of with the crowd. So to me, there was more of a togetherness in this 25 move, and this idea that there's some sort of lack of cohesion at the Fed. Really, Stephen, you expect given where he's coming in, but I thought this was a much more cohesive announcement that they're comfortable with a 25. There's two more priced in. The balance of risks is cuts. The market's pricing really two more cuts for the end of the year. I think they got what they want. They didn't get an overly dovish storyline built into the market. Maybe they didn't even want that. And the market thought they might have that. But then he pulled that back when he said 50 wasn't discussed. But I don't think it's a huge setback. There's a lot of other great things going on for the stock market and for the outlook for earnings, investment, returns on capital. We don't need monetary policy to be neutral. It just would help, and it probably would allow more jobs into the system. And it would be a tailwind to more success rather than a headwind to the successes that we already have.
Okay. David Zervos, thank you. Appreciate you.
Always a pleasure, John.
Well, Bullish, the company, reporting results for the first time as a public company. Those details are coming up next. Plus, President Trump's state visit to the UK. We will bring you the pageantry and the business side of the trip. And shares of Hologic jumping in the moments before the close on reports that Blackstone and TPG might be interested in acquiring the company. They initially made a bid for the company in May, but Hologic rejected the $16 billion offer. Overtime's back in 2.